set up. Okay, so hello everyone, welcome back. So today we're going to go back where we left off last time. So last time I kind of messed up a bit of, I did some great bond plays and also made up a bit of mistakes. So I decided to put my face cam on. That's a good start for live content. So I decided that was a good idea. I'm just going to turn off my video capture real quick. Oh wait, no, I want to turn off this. Just give me 1 second. Just gonna charge my phone where I'm at. Okay. Okay, here we go. So, display capture, disclaimer. Turn that on, but I'm gonna get rid of that. So, hello everyone. Welcome back. So, last time we left off, I had, we're doing the bond only challenge. So in this case, I got kind of messed up from, oh, sorry about my dog. She's just a puppy, and she just wants to say hi. She's like, hello everyone. So last time we left off, I bought a junk bond, and that's why I put in my description of my video, is I decided not to buy any more C bonds, because in this case, Gateway Computers is considered a C bond. So they're basically on the verge of bankruptcy. So if we look into the company, their financials aren't so good. They had $300 million in bonds outstanding, and so they had to discuss with me, and I made it $200 million, which a bunch of other people voted on too. So I found that very interesting. So in this case, they don't have a lot of assets, but they probably have a bunch of line of credit, or they probably don't. No, they don't have any lines of credit. So it's highly likely that this bond that we bought from Gateway Computers is completely worthless. So the question is, should I take my losses on it? Not really sure. I'm probably just gonna keep it just for the income, and if they do make a comeback, I'm happy. But basically, this entire $70,000 we invested is completely gone. So my current approach, Outback Steakhouse, how much is their? I'm pretty sure they're investment grade. Yeah, they are. So when it comes to the rest of our bond portfolio, I took a loss on another bond, and I'm pretty sure if I have my thing. Here we go. I have this. I saved this as a thing. So in this case, we have my bonds. We have Baker Hughes bond, which is a junk bond. We got rid. Oh, we kept that. We have Gateway Computers, which is a junk bond, and then we also have Outback, which is a good one, and Natel, which is convertible. So I found that kind of interesting. But we have $404,000 just sitting in cash. So I think one of my realistic goals this episode is going to be to try and hit 1 million under assets under management. So we start off with 100,000 USD. In this case, we have 400,000 just sitting in cash. So one of my main objectives during this entire episode is basically just going to be to try and boost up our income and not buy as much low quality junk bonds, because I'm pretty sure the two of these bonds are C grade. So they pay out great interest rates, but the chances of them defaulting are much higher. So I'm thinking about moving my strategy into, so if I go over here, if I go to the database search, we want to do regular bonds. And we want to do, so if I look over here, and we see like the AAA, so triple A's, I want most of our money being invested in triple A's to triple B's. So we got our triple B's over here. So last episode, I talked about like what investment grade bonds are. And so in that case, we bought a ton of investment grade bonds, but then I decided to take a little bit of a risk and go way down here to basically where junk is. So right here is junk territory. A double B bond, double B, single B, and then C's. I want a single C bond, but in this case, Dutch Alex is triple C. So right below that is D. Basically means that the company has defaulted, and there's low chance of that company surviving. So in that case, I am going to start backing away from C bonds, and maybe start going into the double Bs if I want to buy junk. But I'm probably going to stick most of my assets under management into just investment grade bonds, because I really don't feel like going into the speculative grade, which is below here. And I also think I decided it might be a good idea, because it technically counts as a bond. We can buy bond funds. I'm pretty sure I'm going to allow this. I'm going to allow convertible bonds and bond funds, which are technically stocks in general, but the investments are in they work like bonds. So in this case, I'm not going to allow basic commodities. I'm not going to allow this. I'm not going to allow this. But the only things I'm going to allow are prudent government securities. So these are government long-term bonds and short-term bonds. And I'm going to allow this. And I'm going to allow this. I'm only going to allow these three, because this is ultra aggressive. Oh, yeah, so like these two are like leverage funds, so they basically use leverage. So if I believe a stock is going to go up and I want to boost up my gains, basically this fund is going to use leverage. And you might be asking, oh, that's interesting. Well, they have this in real life. You can buy leverage funds, but they're very, very volatile, and they're typically not meant for the regular investor out there. They basically use debt to invest, and you can get really messed up. And we've got these are all stocks basically, so I don't want to be exposed to equities. I want to be exposed just to bonds, so I'm going to allow these three. So maybe for junk bonds, I'll expose myself to the high income bond fund. So if, for example, if I look into it, it's currently a sell from analyst. So just because it's a sell from analyst doesn't mean it's potentially not worth a buy. Invest nearly all of its bonds with the junk credit rating of BB and lower. So BB and lower, like I said, is junk category. So this is a high income bond fund. Whenever you see this in real life, a high income bond fund usually means that it's more risky, because they're buying basically junk grade credit, where companies have a very, very high chance of going bankrupt, and so they have to pay a lot more interest in that case. And so investment grade is considered great. And and yeah, so we got that. So I want to see what their assets are. So they currently have $32 million in corporate bonds and $11 million in free cash. And the dividend yield is 7%. That's pretty great. So we'll be making way more than we are currently making right now off of the prime rate. Currently, the long bonds are making us about 4%. And the benefit with this is we get diversification. So I tend to not really talk about ETFs much in my investment knowledge, just because I mainly invest in individual stocks, which are very, very high risk. But I'm actually planning on easing up my my portfolio and actually going into ETFs, index funds. Like personally, not really financial advice or anything, but if I go over to my my two most favorite index funds out there. This is in real life too, which I find is interesting, is the VCN. So if you basically want exposure to the all, so that's why they say all cap, because they got small, medium, and large companies in Canada. So that's where if you want to get like invested in Canada, because I'm Canadian, so I'm a big fan of the VCN. And also another one is VDY. So like this is the high dividend index. So like this is high dividend, so they buy companies that have very, very high dividends. So this actually gives you a good amount of dividends. It doesn't have the dividend yield posted. Let me go ahead and go to Yahoo. And you might be asking, oh hey, why do I use Yahoo? Well, I'm more used to Yahoo than Google, but I could probably use both of them. So in this case, the yield on the VDY is 4%, which is pretty good. And year-to-date return is 20%. So that's pretty great, but that's just because we're in the roaring bear market. And so that goes into what my thoughts are about the market. Well, this is some personal ranting, so this has nothing to do with the series, but I made a few changes to like my Google Sheet. So here's my Google Sheet where I manage all my bonds and I manage all my stocks and everything. And so like this is, I have disclaimers to saying like this is not really financial advice and you shouldn't take it, but at the same time I would say just do your own research, and if you're having a bit of difficulty, seek an advisor, which I want to be an advisor in my future. So that's why I kind of started this YouTube channel, is I wanted to share my knowledge and try my best to teach everyone. So in this case we have my portfolio 2, which is my TFSA. I have one thing I found very interesting this morning. I was watching Kevin O'Leary, which I found is very, very interesting because Kevin O'Leary actually has a YouTube channel. Like I think a lot of YouTubers out there, they have their own YouTube channel. So in this case, Kevin O'Leary, I found this very, very interesting because Kevin O'Leary apparently has his own YouTube channel. And I would say he's one of my first favorite mentors that taught me on how to invest and stuff. And he believes that basically you want to keep at least 5% of everything in your portfolio. So I'm not really following exactly what Kevin O'Leary is doing, because in this case, I have 12% in Suncor, and I'm concentrated. A lot of my risk right now is concentrated in utilities and financial companies. So if I did the math correctly, I'm pretty sure about 30% of my entire TFSA, this is the portfolio we're looking at, is exposed to Fortis. So in that case, it's not really the smartest when it comes to diversification, but I understand the business of Fortis really well. And I'm not exposed entirely towards just common shares. Like about 18% of my entire portfolio is exposed to common shares, while 3% plus the 8 is in preferred shares. So these are nice, like a mix of so they're basically a mix of bonds and stock. But like you don't get the safety of bonds when you're buying preferred shares because they pay out dividends and companies can cut dividends at any time. But I found that kind of interesting because these preferred shares pay out a lot. And during Corona last year, I bought the Series G at $14 because I thought it was a steal at that time because it was yielding like 7%. So I did a bit of an analysis on it. This is really, really old, but I basically said that, oh, hey, if rates remain the same, blah, blah, blah. So I basically locked in at 7%. And then for the Series K, I lock in at 6%. So in my case, I'm like, these pay out great yields. They're a bit of a mix of bonds and equity. So in that case, I really, really like preferred shares. So that's just mainly because I'm a dividend investor. I barely ever go into growth, but I'm starting to exit my comfort zone because my comfort zone right now is in growth, dividend stocks. So that's why I don't make a lot of flashy titles saying, hey, buy this growth stock and make X amount of dollars. Well, I just believe in making passive income for life to a certain degree. Because, like, I bought Suncor and they cut their dividend, so it's not really passive income for life. But in this case, my stocks went down quite a bit. But I'm just trying to... I'm currently 20 years old, and I just decided to start investing when I was 16. And I just always been very interested in dividend stocks. And while as I get a lot more assets under management, I decided that it's a really good idea for me to move into growth, and that's where the real money can be made in the long term, especially when you're young. But yeah, so like that's why I'm doing the bond portfolio. Is like this is preferably you would want to do a bond portfolio as you get older because bonds are much safer than stocks. So it goes basically as a hierarchy. It goes basically the highest risk one would be growth stocks. And you can go even higher than that, do leverage, you can do options, and if you're doing ETFs, you can do those leverage ETFs like we were talking about before. So this is just me rambling, by the way. I'm just talking what's on my mind. But right now I have, I think dividend stocks are somewhere in between, in the middle, and then you got like your bonds are very low risk, and then you got your high risk, which is technically growth stocks. So this is my growth portfolio. I'm trying to quote unquote beat the market, and I'm not doing super duper well on beating the market, but I'm just trying. I'm trying to buy more growth stocks and get more familiar with it, and I could probably make a lot of money if this is basically my money maker right here because I buy a bit of high risk stocks, higher risk, but I also decide, hey, like recently I bought Tasco Mines, and I think it's a really good deal. So long term, I'm long Tasco Mines, and yeah. So with this portfolio too, it's mainly just prudent investing, where it's dividend stocks, etc., etc. But I found it very, very interesting from this video. I watched almost this entire video. I made it to like 35 minutes in this video. So I found it very, very interesting, where he said, basically Kevin O'Leary says this one important thing that made me reconsider my entire investment strategy to a certain degree, especially when it comes to my portfolio too. And that is, he said basically there's something called duration risk. So in this case, Kevin O'Leary is not buying any REITs or anything. He says in that video he's not buying any REITs. And it's like basically here's the video. But he said like duration risk. So in this case, it's basically the economy. So if you look at my entire portfolio, Suncor, they have a lot of leverage. So therefore, they're highly durational risk. And Kevin O'Leary also doesn't like oil. He doesn't invest in oil for the long term. So I'm honestly, that's why one of the reasons why I'm just, once I start making, like, I'm probably going to exit out of Suncor entirely once it hit $50, if it ever does. And then I'm going to rediverse my capital somewhere else where I see it better, because this goes into ESG. I think that stands for environmental, social governance. But a lot of investors about my age, they believe that oil companies are bad for the environment, and they're going to eventually be obsolete. So a lot of people, they think basically that when it comes to Suncor, they're going to believe it's potentially obsolete. Their returns on capital are going to be less over time. And so that's why Joseph Carlson, a while ago, he ended up selling out of his entire oil position at a loss. So I found that very, very interesting. But currently right now I'm holding oil. It takes about 12% of my entire portfolio. And that's the only oil stake I have in my net worth. So I'm quite invested in oil, but I'm not super duper low on oil companies. I do believe there are a great value. Well, that's actually not true about 12%. I have quite a lot of my money in oil. Like if you look at with portfolio 1, I have about $2,500 in Enbridge. So I would say I'm heavily exposed right now to oil. So that's one thing I'm probably going to consider switching out of in the long term when it comes to me. So in the next few years, I'm probably not going to be buying much energy stocks lately. And I'll be buying companies that probably have lower duration risk. So that goes into where I was talking about before. Suncor, they're very, very risky in the long term because, like I said, ESG, people are phasing out oil companies. Russell's cyclical in nature, so that's considered a duration risk because it has to follow. It follows the economy. Locora, that's technically a bit of duration risk in there because it's cyclical. A lot of these stocks I hold are cyclical because in nature, I think that the economy is going to be recovering. So that's why I bought I have Suncor, which is cyclical. Russell, Locora, CGX Bond, which is cyclical. It's consumer cyclical. So it's not. It's the company. It's a convertible bond. So Cineplex in nature is a cyclical company, and HOT is cyclical. GRT I wouldn't consider that. Bell, I'll consider them semi-cyclical, and then that's really it. About half, and then QSR. So about half my portfolio is in cyclical stocks, which are potentially high risk. So if I were to name one thing with my entire portfolio is my main risk with portfolio 2 is interest rate risk. So Fortis, they have a lot of debt. R&W, they have a lot of debt. Bell, they have a lot of debt. GRT, they have a lot of debt. HOT, I think they have a little bit of debt. But this has a lot of debt. 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 So a lot of the companies I buy, they have a ton of debt. Suncor. So that's one thing I'm probably going to offset a little bit over the future is maybe buy a bit more quality-based companies. I would say Bell is pretty quality, though. Not going to lie. Anyways, that's enough ranting for now. I would say if you guys want to do ETFs or these are index funds, I would say do the Vanguard VDY and then if you're also American, you can do VOO, which is basically S&P 500 ETF. So it's a little bit expensive, but this is like the most popular. This is a great way because you're buying the top 500 companies. But like I said in that video and over Kevin O'Leary, is with Kevin O'Leary and everything. He said that like he only has about 100 of the 500 companies because I think Meet Kevin. He said that about a bunch of them are tobacco-based companies, oil companies, and the S&P 500. So what you could do is I could look over the entire S&P 500, all the holdings and the 500 companies, and I could pick out some specific companies out of there. And I think that's called portfolio sampling. So that's one thing I'm probably going to be doing is I'm going to be doing portfolio sampling. Definition. So it's basically a portfolio is a collection of work samples. That's not right. That's for employment. But anyways, that's enough ranting for now. But I might just pick out like 100 of the top 500 companies in America and invest in that. But as of right now, I have barely any liquidity as it is. So if I... One last side tangent. I'll go into more detail. I'm probably going to start working on actual videos instead of going live. But going live as of right now is just easy and convenient for me because I can just chat with you guys. But I made up a gains and losses tab, made up a personal finance tab. The entire day yesterday, I worked on my personal finance tab. So I found this very interesting. My other personal finance tab that I worked on, it was all messy. I didn't like it, so I decided to make it a little bit cleaner. So in this case, I have my income. So I have like a bit of personal expenses and stuff in here, but I have like how much income I'm getting from my investments. So I like to think of myself as a corporation, as a company. So in this case, I have my income, and I have my investment income. So like this is my income statement, and this is every month. And then I have my total real income, and then I have my employment, plus my investment. But I tend to never ever cash out my investment income. I used to do it when I first started, but that could be a bit of a problem because if, for example, if I'm cashing out my investment income, then my portfolio doesn't grow as fast because I'm constantly cashing out cash flow. So, like let's just say for now, example, if I look at my portfolio too, I have $800 just sitting in cash. I can literally cash it out of my brokerage, but it's in my TFSA, so I would have to wait 1 calendar year. So, for example, if I were to cash it out this year, I would have to wait about a year from today in order to put that money back in. If I do put it in before that year, I'm going to be taxed on 1% because I over-contributed towards my TFSA. So it's a little bit tricky with the stuff, but that's also one big reason why I don't cash out my TFSA and everything. Some people might be asking. But with my taxable, I could theoretically cash out all these stocks, take a bunch of money, and then do anything with it. I could go on vacation, etc. But in my opinion, that's not as smart because when I go on vacation, my money's not working for me. So I prefer having my money work for me. And so if I go my personal finance, I have some total real, I have some fixed expenses and stuff. And I have my checking, I have my savings, USD holdings. I have some long-term assets. So like I like to think of this as actually a company out there. So they have two different types of assets out there. They have short-term assets, which are highly liquid and I can get out for like less than 1 year. So in this case, that's why I included my GIC in there. If it was for until 2022, I would consider that a long-term asset. But it's matured in about September. So in that case, I'm pretty happy with that. So in that case, I'm considering it a short-term asset. So I have some checking, I have some savings, I have some USD holdings. The USD holdings is literally just sitting in cash. I may end up cashing that out and then moving that into a American stock. I'm thinking about maybe going to AT&T. But yeah, today's just mainly going to be, I'm going to start ranting for a little bit. But then I have a high interest savings account. I have some savings accounts, and then I have my long term. So like these are stocks and bonds. So I have a portfolio 1 income, portfolio 2. My portfolio 1 right here, this is mostly income-based stocks. There are more speculative plays in it than portfolio 2. So I was going to consider this a mixed account, portfolio 1. But portfolio 2 is definitely income because most of these stocks in this portfolio pay income besides Lucora. Because Lucora doesn't pay a dividend, but all these companies in here pay dividends or coupons. CGX pays me a coupon. because it's a bond. It's a convertible bond. Portfolio 3, this is my growth portfolio. So this is where I want to try to beat the market and make excess returns and then reinvest that into blue chip stocks that pay dividends. And so like this is a bit of a dividend account, but I mainly aim for more capital gains in this account. So that's why you see a bit more higher risk plays like Taco, SNC. SNC has been doing me really, really good lately. So I'm going to be long SNC. I was tempted on trimming it, but then they had a really good quarter, and I was potentially happy with that. I looked at over the report, and I'm having a bit of questions about their long term. But like they should be able to make profits in the future. Yeah, so I'm holding this until about 2029 SNC, just because they got banned for 10 years for making contracts, because they did a bunch of shady stuff back then in the past, and so they've been banned 10 years for government contracts, etc., etc. Power, which is a long-term holding, I decided to trim that, so that's why I put in my gains and losses. It's taxable. I sold out. I sold 15 shares. I made about $500, and so like that's where I got my money from to buy Tasco Mines. I sold out my IAG. I had some Industrial Alliance in here. Sold that out at $67, and then I also sold out some of my power, and then I bought about $900 of Tasco Mines. I have some Texas still. I trimmed out $1,200 of it a while ago, and so I'm pretty glad I trimmed, because at the moment it's starting to fall down quite a bit. Sadly, the stock I did end up replacing it with is actually down about 12%, my Quarter Hill. So I'm actually thinking about going into Quarter Hill more. I feel like that is potentially a good value play. The only thing I really don't like about Quarter Hill is their margins. Like their income statement could be a lot better, but their balance sheet is almost pristine. They have like no debt. So not going in like this is like not really financial advice, but I would look over all these companies if you guys want to mimic what I'm doing. But I found it pretty interesting. And I have Enbridge, which just pays me a nice amount of dividends. But I'm going to be trying to buy more growth companies. And then if I look over here on my portfolio 4, which is just my small income account. So I was going to probably make more videos about this, but I want to do it on the computer, but I have to do it on the phone to trade for Simple. So hopefully in the future I can maybe make some more videos. And maybe when I'm done my year 3 of college, like next semester is my year 3, and then when I get out of college, I was planning on contributing maybe like $100 a month towards this account, and then I'll probably make weekly or maybe monthly videos and just update you guys on what I'm buying, why I'm buying. I think that would be a fun idea, so I'm going to be doing this for the long term. So currently this is not doing so well for me. That's just because I haven't updated the Drone Delivery Corp. So I just usually click on this link, and then it's $1.22 right now, so I'm actually losing a lot of money. So I've lost quite a bit of money, but how it's weighted is important. Most of my portfolio is in Smart Centers REIT, which I still think is quality, but I looked at their price to earnings ratio like literally a few minutes ago, and it says 70 times price to earnings, but they yield about 6% on dividends, so that's really good. But I think that's non-eligible. So there's eligible dividends and non-eligible dividends. So not eligible, they're taxed less efficiently than eligible companies. That's just because SRU, like REITs and stuff, they're considered non-eligible because they pay out most of their dividends to people like me, and I have to pay a lot more because in that case it's basically because they get a tax break. They get a tax break if they pay out like 90% of their income to shareholders. So I have to foot the tax bill mostly. So I found that kind of interesting. And I got a biotech stock in there. Okay. Some ranting happening. And I got my S&P 500 US equity. So I do this just for a bit of exposure to the S&P 500. Just because I want... This is like my easiest index fund. So... It's an ETF actually. I barely pay any attention to this. It's just very, very passive in nature. So I don't I almost forget it exists because I don't pay any attention to it. We got my Linden Loop. So I found this very interesting a few years back, around 2019 or so. I decided I have some spare cash left over from when I was working. I decided to put that into a some small business lending. So that's why I say lending loop, because it's actually you can actually loan money to small businesses. The only problem is they're not very liquid. So a lot of these loans I buy, they're 3 years plus, and I can't cash them out anytime I want. They're highly illiquid. It's kind of like buying real estate. But they do give out good rates of return. I'm pretty sure. I recently bought into a loan where it's basically a very safe small business company, and they're paying about 12.82% a year in interest. So it's just a nice side way of me making money. The account's worth about $456, so that's why I included in my balance sheet. And it's actually in my income statement too. My income statement, I've so far for April, I've made about $4.56 minus the fees. Well, that's including fees. My bad. But yeah, so like this is just a set and forget strategy for me. I'm starting to switch over to a bit more of a set and forget strategy. If you look at all my individual stocks, like portfolio 1, 2, 3, and 4, I make things way more complicated than they should be. And so that's why I'm aiming for a bit more of a simpler strategy. Like I've talked into a few of my friends, like one of my friends I got into invest in, I told him, legit, if you're a beginner and you don't really feel like putting a lot of time and work into the market, just buy index funds, buy mutual funds, etc. Because you don't have to do what I'm doing. What I'm doing is just overkill. And a lot of the times you actually underperform. Like right now, I'm willing to admit that I'm not the best investor in the world, but I want to get better. Like if I look at my returns, portfolio 1, I made 5.7%. Woohoo! That's actually pretty bad, because if I would have bought an index fund, for example, if I would have bought VCN, it would have made me about 11.6% plus 2% in dividends. So in this case, I'm underperforming the market, and I'm putting more work into this portfolio than just simply buying this. If I could have just simply bought this fund, and I could have done better than when I actually bought the individual stocks. But this portfolio has earned me 10%, so I'm starting to look a little bit more competitive than this index fund. But what's important is portfolio 3, where I actually took a little bit more risk, and I decided to make bigger plays into stocks that I think that have more potential, like Texas. I thought that had great potential over the future. Taco. Like for example, most of my portfolio is in Fortis. I know that they're a utility-based company, and they're basically going to be nowhere. Like they're not going to grow as much 5 to 10 years out from now, because it's like their business model is very boring. So like that's the one thing I'm willing to accept with this portfolio is I buy a lot of boring blue chip companies. I'm not buying like smaller cap companies that can grow a lot faster. Which in portfolio 3 I'm buying higher risk companies that I think that have way more potential to grow over the future. So that's why in this case I made about 22%, and then plus the income. And so in that case I actually have a little returns compared to the market. So in this case, my alpha for portfolio 3 is 9%. So that's just comparing this index fund to my actual fund return. So I return about 24% off my portfolio 3. That's an alpha of about 9%. So if I do basically 24 minus the 14.88, I get about 9 point. Yeah, that's how I got it. Anyways, that's enough ranting for now. I think it's about time I go ahead and get into it. I'm just gonna get my piece of paper out. I'm gonna start taking YouTube a little bit more seriously. So timestamp. I want to timestamp this. So we made about 34 minutes. I'm actually gonna do the bond. Okay. Enough ranting of what changed. I'm actually gonna probably make like a little bit more of a condensed video, like I said. But now we're going to be going back into my bonds. So I hope you guys enjoyed that little side tangent where I talk about my investment portfolio, etc., etc. So that's just my personal portfolio. I'm trying to manage it better. I'm trying to manage my money better. Right now, I'd have to say that my personal finances are probably the worst part because I'm a student. I'm not making any money, but I'm hoping to become employed during the last 2 months of summer. Make a little bit extra money, And I may just keep that in cash because I really can't. I'm going to try to contribute as much towards my TFSA. Okay. So I lost where I left off last time. But right now, interest rates are at low levels. So right now I'm just going to keep a bunch of in cash. Maybe buy some liquid bonds. So if I look at like the current year, it's currently 2031. Cool. So now I'm going to buy up a liquid bond. So like that goes into like basically where I had like the $800 in cash. About 4% of my actual portfolio, like I was showing you guys prior. Going into another rant. Good job. But I tend to rant more when I'm live. That's my bad. But in this case, Kevin O'Leary in that one video, he also said it's very, very important to have dry powder. So in this case, I have about 4.28% of my portfolio. Before my capital gain that I sold off on IAG, I had about 39 shares, so 10 shares made this much. So in this case, if you look at IAG and my TFSA, I made about $600. I basically went from like 2% in cash to 4%. So one thing I was told is that you want to have typically 5 to 10% of your portfolio in cash. Some cases you can go extreme. You can do 30%. And then that's just the reason why you want to keep cash is it doesn't move. There's like no, I can't make money off cash and I can't lose money off of cash. So in that case, that's one thing called liquidity, which is very, very important to have. And so that's what I'm going to try to do with my bond portfolio in this game, is I'm going to try to have liquidity. Because when I'm buying bonds, they're inverse related. So right now interest rates are low, and I'm betting that they're highly likely to go up in the long term. So in that case, if I'm going to buy a bond, I want to buy short bonds. I don't want to buy long bonds. So that's why I'm going to do bond laddering, where I'm just going to buy up short-term bonds. So it's currently 2031. I'm going to be buying up basically highly liquid bonds. So in this case, there's a 2033 right here. I kind of like this one. I may just put like 200K in this, and then I will go ahead and forget about it. And then 2033 it matures. Hopefully by 2033, rates will be much higher, and I'll be happy. So I'm just going to buy 200 of these. It's about $208,000 for that. And it's going to make me about 5% a year. So it's going to make me about 10%. So I'll make about $7 profit per bond. So in that case, it's pretty good for me. And so that was considered investment grade bond, I'm pretty sure, right? That was that bond that we bought, 2033, right? 2033, right here. So we're going to add that to right here. 2033. And this is VIVENDI. And then, so like this is considered investment grade. They're paying me about 5.55% in coupons. So I paid a bit above par for it, but I'm okay with that. As long as the income is bigger than the par value, I'm okay with that. So I'm just gonna keep I'm gonna keep lots of liquidity, $200,000 in cash. If rates go up, I'm gonna start doing more investments. But as of right now, I really don't see any real way of buying anything with my liquidity. So that's one of the benefits of keeping cash. It doesn't move in value. It doesn't go up or it doesn't go down in value. Over the long term, it will go down in value because of inflation. Okay, I really don't need these earnings reports, so I'm actually going to suppress them because they're very, very important for stocks, but they're not super duper helpful for me. It's very, very important in real life to pay attention to earnings reports, see how much your companies are making. But right now, as me being a bond investor, all I care about is whether their ability to pay the bond whether they have the ability to pay the bond or not. If I was doing individual stocks, I would really be reading these the reports. I should be, but that's just gonna bog down the video, and I want to try to hit 1 million. Okay. So right now we have $206,000 in cash. We're making about $45,000 in interest, minus all of our So we're making about $47,000 in income. Minus 13,000 bond premium. About 11,000 in projected. So we're making about 21,000. So by the end of the by 1 year from now, we should have 312,000 because we're having maturing bonds of 70,000 soon. So that's the benefits of bond layering. Is I'm just buying a bunch of short bonds, and it's very, very helpful if there's something called the yield curve out there, which I don't pay too much attention to, but if I have the ability to, I find that pretty helpful. So in this case, I found this very, very interesting. There's something called the yield curve. So in this case, the longer term maturities you buy, typically the longer you lock your money into bonds, the more percent you make. While as the shorter term, you make less. Makes sense because you're locking your money in for longer periods of time. There's a chance that company could go bankrupt 30 years from now. There's a chance there could be hyperinflation, etc., etc. But then there's also the inverted yield curve, which is great for my strategy where I'm doing bond laddering. Inverted. Where it's basically the opposite. Short bonds are paying more than long bonds. People are dumping out of long bonds. Oh no, maybe a lot of people are buying long bonds, so that would make the price of them a lot higher. And so the short bonds actually pay more than long bonds. So in this case, if I actually look at like the actual bond market in this game, I could probably determine whether or not short bonds are actually paying more than long bonds, and I could do that. So in this case, a 2045 bond, and we got a 2033 bond paying almost the exact same as the long bond. So I'm pretty sure, if I were to look at it a lot more, I'm pretty sure they should have the yield curve in this game. But in this case, you could actually do it with the long bond and the short bond. Typically, if the long bond is the short bond. So, for example, if the short bond was at 5% and the long bond was at 4%, that would be inverted because short bonds will make me an extra percent. So I would find that pretty interesting. So right now, the short bond took a bit of a tank. So it's pretty likely that interest rates are going to go. It's pretty likely that interest rates are going to fall in the near term. So I'm going to go ahead, take a little bit of a risk, and buy 200 of these. $201,000 is going towards long bonds. This is a little bit of a short-term deviation from my original strategy. We're going to lock in at 5.25% on the long because we saw that the short bond tanked. But the long bond didn't tank as much, but it would eventually, hopefully, fall more. Because the short bond is usually what determines the long bond, and the long bond is what determines the prime rate in this game, at least. So now that the short bond has fallen, I'm pretty sure that the attitude has changed. So the central bank is now easing. So typically whenever the short bond crashes in this game, it means that they're going to go into an easing environment. Typically, if it explodes, it means that they're going to go into a tightening environment. If it stays mainly flat, or if it goes up a little bit or down a little bit, it's typically neutral, in this game at least. So I found that pretty interesting. So we locked our money into long bonds, and we made some decent profits so far. And if they continue to ease, which they have, the long bond will continue falling, and I'm going to make a bit more hefty profit. So it continues to fall. So there's a lot of, oh, it went up a little bit, but it's fallen again, about 10 points. Fallen. Oh, it crashed recently. So right now their money is very, very, very cheap right now. So it's actually a good idea I should have bought long bonds, hypothetically, but we bought a bunch of short bonds. I could have made potentially a lot more money if I locked my money in for longer periods of time, which I did for the government long bond, which is a very, very high risk idea, but it paid off so far at least. So if rates keep falling, I'm going to make a bit more money on my long bond. Okay, so right now I think it will be a decent idea to take my profit on that long bond. So we bought the government long bond at 100, and now it's currently at 135. So we made a bunch of capital gains off of the bond. And so we have like currently about almost $300,000 just in cash. So we made a decent amount of profit. So if you look at my chart, I've made a decent amount of profit, so that's good for us. I could have leveraged that and made way more money. I could have borrowed money from my margin, from my broker, and I could have took out so much more leverage, and I could have made way more money than that case. But what if rates went up? If rates went up, I would be in so much trouble. I'd be in so much trouble. So it's currently 2032. If we look at my little calendar I made, the Baker Hughes junk bonds should mature soon. But the big question is whether or not they're going to be able to pay me back. I'm going to say that's pretty unlikely. We actually made a bit of a profit off this bond. So it's actually maturing like next year. In this case, they have, I would say they have enough liquidity to pay me back. They have $400 million in cash. And they have $300 million in bonds outstanding. But they have a ton in bank loans. So but they have a ton of unused lines of credit. So Baker Hughes actually made a bit of a comeback. Like, I'm pretty sure we bought them when they're in junk bond status. But now they're investment grade status. So I'm just going to hold that bond. Because it's highly likely they're going to pay me back in this game. Okay. It's highly likely they're going to pay me back. And I think I'm going to probably put like, how much taxes do we owe? I should have checked that. We owe $26,000 in taxes from that capital gain we made. We made out $62,000 off that transaction that we did. The transaction being the government long bond that we bought a bit ago. So I found that pretty interesting. This strategy is definitely a lot more boring than having a bit of a mixed portfolio where I have a mix of stocks and bonds. I think it's about time we add some stocks. But by stocks, I mean we're not going to be buying actual physical bonds out there. We're just going to have a bit of diversification. So we're going to do ETFs. I'm going to allow this because it technically counts as buying bonds. I'm exposed to the bond market. So I found that very, very interesting. We're going to buy a junk bond ETF for like $90,000. So it's a hold right now. They have a bit of a balance between the two. But this should be able to pay me out a ton of money. It's at book value. And they pay out, what's the dividend yield on this thing? 7.24%. So I wouldn't have to do as much of buying and selling if I literally just exposed myself to these bond funds. So I found that pretty, a screen snipper, I want calculator. So in this case, we're going to go ahead and we're going to buy up, I want to have this as a long-term investment, so I'm going to have $88,000 in this bond fund. I'm just going to do it long-term. So we have $88,000 budget, and then we do it by the asks. So I'm gonna pay $42.34. So in this case, this is how I buy my stocks in IRL. Is a lot of the times I just do my budget, which is in this game it's $88,000. But a lot of the times, my big stock plays are $2,000 plus. You could do it for $100, but you just do your budget and then you divide it by the ask, because the ask is how much the seller is willing to accept. So in this case, he's willing to accept $42 for this fund. So in this case, we're gonna buy 2,078 shares. I could round up or I could round down. I'm gonna round up by 2. I'm gonna put a little bit extra into it. I'm going to pay $88,077. We're going to pay a $10 fee for that. And so right now we have $89,000 in a high income bond fund. So I'm going to say no more junk bonds from now on. I'm just going to be doing bond funds for that. Get my diversification through there. Maybe later on in the series I may buy a double B bond or something. But as of right now, I'm just going to stick to just bond funds for more diversification. But we're going to put a lot of our money towards individual bonds. That way I can show some decent bond strategies like bond laddering, locked into long term. But I'm going to start switching a bit of my money to funds just for a little bit less work. So in this case, this bond fund we bought, we don't have to really do anything. All we just gotta do is allocate capital. So that's how easy it is. It's also easy IRL, because if you buy bond funds, you don't have to do any of the individual decisions. I don't have to go out there and decide what bond do I buy. The people that manage the fund do it for me. So in this case, as an ETF, it's more passive in nature. So there's less buying and selling, but they're still doing work for me. So I really don't have to do much. So that's one big thing I like about in this game of ETFs. So I just decided to buy that ETF. So that's pretty interesting. And we received about a dividend. So this is not interest, this is dividends, but technically we bought a stock in this case because it's an ETF, but it's alright. And they gave us $2,000 in income. So that's a big benefit of me buying this ETF. We just made $5,000 plus. So I'm going to do, right down here, we'll do a, so we contributed about $87,000 in a junk bond. Oh, I'm trying to type there, buddy. I also have to speed up pretty high. I think I gotta slow things down a little bit, maybe. But then again, that would make the, like, this game, it takes forever to beat. Because in this case, it's 2033 so far. We started in 2020, so it's been 13 years so far. And it ends 2052. So we have about less than 20 years left, 19 years left. So that's why I like having it on high speed. But a lot of people might have trouble comprehending what's going on. Plus me. So in this case, the bond yields are actually getting pretty attractive for me right now. And we have $280,000 worth of play money. So I think once the long bond hits about 8%, I'm going to start buying $80,000 increments of the long bond. And that's if they continue to rise. And when interest rates did go down to like this all-time low level, we could have sold out of our corporate bonds, but we did not. So that was a little bit dumb. But hey, it's not the end of the world. So by 2020, current year, 2033. So our bond that we bought of 200K, it's maturing by 2033. And what happened is what I was actually wanting to happen is by 2033 I wanted rates to be higher. So I bought a 2033 short bond at 5% of the prime rate. So I bought it around here. And rates are actually higher 2 years from now. And once that bond matures, I'm going to be able to put that $200,000 to work at a higher interest rate. So that's the one advantage of me doing this bond ladder strategy. So if we wait a little bit, we should be able to have... Oh, we got our money back from the V company. So this company, they pay us back in full. And so now we got $487,000 to play with. So now I'm going to start buying government lawn bonds and buying corporate bonds too. That's the one thing I was tempted on doing is I could just buy corporate bonds only and avoid government bonds. Like I could literally just buy long-term. So it's currently 2033. I want to start buying long-term corporate bonds. It's 2056. That's a long duration. This is a very long duration. What's the longest duration out there? This goes into A. So I think this is a really good coupon, 10%, and the bond's been hurt a ton lately because interest rates probably went up a lot because it yielded 4.5 when they issued it. So that was around when the prime rate was probably 4.5%. But now that interest rates are almost double that, it's paying out so much more now. So that's why it's got hurt a lot. So right now I'm going to buy up a ton of this bond just because I want to. So I'm going to buy up maybe so it's currently trading at 500, right? 500 per bond. So I'm going to probably put $180,000 into this bond. It's paying a 10% coupon. That's pretty great. So it's about $500. So I can buy about 360 of these. So that should be around 180,000. A little bit above. not a big deal. So we bought up a load of that bond. Right? Yep, we have a ton of this bond. It matures in 2056. So we have a bit of duration risk. So in this case, it's a bit of a long-term bond. So if interest rates continue to climb, it's really going to hurt us. But worst case scenario, it's going to pay us 10% coupons year over year. That 10% could be reinvested towards, if interest rates do rise, I can put that 10% I'm making to basically the income I make from this bond. I can buy in at higher rates. So it's really not much of a risk, but it's a risk to consider. Okay, and we have about $302,000 just sitting in cash. So I'm going to start buying the long bond on the government. So it's at $720, right? $72. So in this case, we have about $8,000 we want to contribute towards this bond. And 727. I should be able to buy about 110 of this. That should be about $80,000. Yep, right, almost spot on. So we bought $80,000 worth of that, and that bond is paying us how much? 5.2, about an 8% a year. That's pretty good. Not as good as the Tenant Healthcare Corp. That's just because I'm taking more risk. But yeah, so that's gonna be my strategy. So when does this bond mature? I want to add this to my calendar. So it's 2052. So we bought up a bunch of lawn bonds. 2052. That's Tenant Healthcare. And then we have a 2056 government. So we have a government lawn bond, and we have a bunch of short-term bonds right here. Once these mature, I'm gonna roll them into long bonds, and that's if rates stay high. If rates go up higher, I'm gonna start buying more and more long bonds. And a nice little $1,000 from our good old bond fund. And it might actually start making sense to maybe start buying more bond funds. Maybe. About I'm gonna probably put 21,000 into buying a bond fund just for a little bit extra fun, for a little bit extra diversification. And I could also a little bit less work. So I want to do this government securities one. I could also do this, but I want to do this because they could potentially make a lot of capital gains. So let's see what their portfolio is. So their portfolio consists of a $200,000 at 8.919%. So they recently just bought a lawn bond. And what I'm hoping is that if interest rates continue to climb, they continue to reinvest and buy more and more lawn bonds. So that's what I'm hoping that management is going to do of this. So I'm going to buy about 20,000 of this. I'm going to do it by the ask, which is $49.59. I buy about 403 shares of this bond fund, which is about 19,000. A little bit below what we wanted, but it's all right. So we have two stocks in our portfolio which are exposed to bonds, so therefore it technically counts towards our bond challenge, which is all right. And we have about $201,000 in cash, and well, here's our income. We have about $1,000 from our cash, $5,000 government bond interest, $36,000 in. So I found this pretty interesting. We put $80,000 into that bond, and we're making $5,775 divided by our $80,000 investment. We're making about 7.218% off our government lawn bond. We've got some corporate bond interest, and so in this case, minus our taxes, we should be making $35K a year. That's pretty good. And we're having $90,000 of bonds maturing soon. So if rates continue to climb, we're going to put that $90,000 to work and just grow our bond portfolio. Now things are starting to get a lot more interesting. Am I still alive? Yeah, I am. My bad. Get kind of worried sometimes. So now we're going to speed things up a little bit. Go back to 99, so it's a little bit fast. And rates are starting to fall, right? Yeah, they've taken a nosedive. So in this case, I'm pretty sure the government changed their mind and now they're easing. I should have bought more long bonds, but hey, let's go ahead and take a bit of a risk. This may destroy us, but I'm gonna go ahead and buy a ton of long bonds and I'm gonna use leverage. Why not? Why not borrow $700,000? This is a stupid idea, but hey, that's why I play simulation games. This might work out. This may not work out. We learn from our mistakes. So as long as the short bond continues to tank, we should be all right. And which is kind of flying off. Fallen. Look at our long bond. We made about $117,000 in profit, but we borrowed money for it. But the benefit is our money that we borrowed from the broker, it's a variable loan. So you may be asking, what is that? Well, if we look at its borrowing rate is 7% variable. So if the interest rates continue to fall and fall and fall, our borrowing cost goes down. So it may go down to 5% borrowing. That's pretty good. And if it's a bit dumb, I wouldn't do this IRL, but if the bond is paying us, let's just say 7%, and the borrowing and cost is 5%, we make a bit of about a 2% spread. We're basically receiving 7%, and we're paying 5%, so we're making a 2% profit. But I'm mainly doing this for capital gains because I don't want to take the risk. Because if interest rates go back up, our borrowing costs will go back up, and we could get really in a lot of trouble. So that's the one disadvantage about variable rate loans is if interest rates do go up, you get in a ton of trouble. But fixed rate, that's the benefit of buying fixed rate. We have a lot. Most of our income comes from fixed rate, which is bonds. Nice little side tangent. So as long as rates continue to fall, we're now a millionaire. Thank goodness. So now rates continue to fall. How much are we paying now in interest? 6%. So that is so much better now. Now we're paying 6% instead of 7% because it's a variable rate loan. So if interest rates continue to keep falling, we're gonna make way more profit because our borrowing cost goes down. We have about $800,000 in margin debt though. We have about $700,000 borrowed, but our bond is worth $1.3 million. We made about $300K so far. So as long as interest rates continue to tank, I think we're gonna make bank. Fallen. Okay, so now they're at 1% for the short bond, 3% for the long, and 3.5% for the prime. So around 1% short bond is when I usually determine in this game that they could go lower, but a lot of the times they typically go up pretty soon. So right now we know that it's basically hit its support. It's like at all-time lows, the short bond. So right now, I think it's a great idea for me to go ahead and cash out this giant profit we made. That's the benefits of using margin. We used a ton of margin. We went from like a AAA borrower to basically having triple B. And so if the interest rates would have kept going up, our value of our bond would be going down, and eventually we'll be having something called a margin call, and then we could have lost the game hypothetically if interest rates went up from when we borrowed because it's variable rate, and our account value will be down a lot. So that's the pros and cons of margin. I took on a ton of risk by using other people's money, but I had extra money. Again, not really financial advice, but I'm just doing this for gameplay purposes and a bit of explanation on why risk is important. I try my best to avoid risk altogether. So in this case, we have $1.6 million just sitting in cash. So we just completely bumped up our AUM by like a ton. So we have about $1 million in cash. Yeah, and about 500K in just corporate bonds just sitting around. So in this case, we're going to go ahead and also sell out of our tenant healthcare. So because we bought a 2056 lawn bond and it was paying us a 10% coupon every year, now our bond is a lot more attractive because it's currently interest rates are actually lower than when they issued. So right now a lot of investors are like, yo, I want this bond. So I'm going to go ahead and give them it. And I'm going to take them a giant gain. And I'm pretty sure I can play around with capital gains and capital losses. I'm not too sure if this is the case. But if I look at this, so we have a $13,000 loss on our bond. But if I look over here, I found this pretty interesting. Right now we have a realized capital gain of $647,000. And so we're going to owe about $182,000 of that will be tax. Which is a lot. But what if I hypothetically, because this isn't a taxable account, you can't do this in the TFSA, but our Gateway Computers bond, we've actually lost about $14,000. What if I hypothetically sell this? So I'm actually going to do what I'm going to do. I'm going to see if there's actually tax loss sell-in in this game. If there is, I'm going to love this game. This game is like perfect for tax. So in this case, I'm going to write this down. We have about $647,000, 893 in gains, and about 182,088, and so this is like our tax bill. Cool. So if you can see, it's right over here on the bottom left. But what I find interesting is, thank goodness our Gateway Computers bond has made a bit of a comeback. If it was a lot bigger of a loss, it would actually be a lot better for us. If what I'm doing is what I'm good, is what I'm expecting. But we're gonna do this thing called tax loss selling. So tax loss selling, Canada. I want to Canada. Oh, I can't type. So if I do it on Google real quick, tax loss sell-in is a strategy that investors employ to reduce their tax bill. If you own shares have dropped in value since you bought them, you can sell the shares and use the capital loss to offset the capital gains you may have. So you might be asking, what the heck is the capital gain? Well, all those profits we made off of our government bond, off of our corporate bond, we decided to sell them and we got a capital gain in that case, which I found interesting. But in this case, we could potentially offset our loss. We could offset our loss by $14,000 by basically reducing our tax bill hypothetically. So that's why I wrote down $600,000 in capital gains and $182,000 in tax bill. So what we're gonna go ahead and do is we're gonna sell our Gateway bond for a loss intentionally. 66 bonds, and we're gonna lose about we're gonna make about $69,000 off of it. But where's our loss? But we lost about $14,000, right? Yeah, here a capital loss of $13,000, whatever. So I'm gonna write that down. So our capital loss was $13,665.14. So hypothetically, we should have negative $13,000 on our capital gains. Let's see if that is true. If that is true, I'm hyped because we can use tax loss sell-in as potential strategy. Yeah. Our capital gains got reduced by like 10,000. So like if you see right here, I'm gonna extend this notepad. See, look right here, I had about 647,893 in gains. Our gains went down all of a sudden. I wonder what it made. I'm joking. It was our tax loss from the Gateway bond. So hypothetically, well, we reduced our tax bill by a few $1,000s. It's not really the end of the world. So we lost about that. I'm pretty sure they divide that by 2, and then you get like 6,000 something. So we actually ended up reducing our taxes by like quite a bit. So it's not. You might be asking like, well, you still make a loss. Well, I made a loss, but hey, I got to offset some of it. I was pretty happy with that. So we paid a little bit less in tax. And we got to get out of that crappy bond. It could have potentially paid us back, but I just wanted to take my losses on it. So now we have $2 million in cash. We're still going to have to pay the government $600,000, so I'm going to keep that in cash and equivalents. But as of right now, I don't see any good deals in bonds, so I'm just going to keep it in cash. We're going to keep our liquidity. What else can we sell? We can sell our Netto Greece bond, which is our convertible bond. 2034. So it should be maturing soon. Market price is pretty high because I'm guessing the individual stock went up a ton. So that's pretty helpful. I'm pretty sure what we can do is we can go over here. How do we convert? Is there a way I can convert that to actual individual stock? I don't think so. But if we look at my portfolio, that's the benefits of using leverage. We made so much money off that leverage, but we could have also gone down a lot because we used leverage. So there we go. We're doing pretty well right now. We're just gonna wait for interest rates to rise before we do any more. But as of right now, I'm probably just gonna be doing bond funds for now, and then just do a little bit in bond funds because, of course, I don't want to be losing a lot. One downside of buying bond funds, though, in this game and in real life is they don't have a maturity date. So I'm hypothetically our stock should be worth a lot more. Our government securities bond, which bought like a ton of bonds at 8%, it made us some money because hypothetically, we look at their portfolio. Where's their portfolio? How do you go to their portfolio? I'm pretty sure it's under financial. No, you can see like their portfolio. Where's their? I think it's under. But their stock has went up a lot because they bought in a ton of long bonds. Basically, the quick summary. Oh, here we go. Here we go. This portfolio. So look, they made a ton of money off those lawn bonds, and so once they do sell that, they can make a ton of money, and then they report better earnings, and then that will make the stock worth more in the future. So potentially it's undervalued, potentially it's overvalued. I have no clue at the moment. But as of right now, I'm probably just, because rates right now are low, I'm just going to go ahead and buy a little bit more of my junk bond index fund. Because right now interest rates are low, so junk bonds hypothetically make more sense because rates are low. So when rates are high, they have more of a chance of going default in this game, at least I find. So right now they have 19 million in cash and cash equivalents. So what I'm hoping is that management of this bond fund will be buying up a ton of junk bonds right now at low rates, especially new ones, because they'll have to pay less. So I'm going to go ahead and buy more of this junk bond ETF, just for a bit of junk bond exposure. So I think it will be if I look at my portfolio, I want to probably put $400,000 into this junk bond ETF maybe. I think that might be a good idea. Maybe stupid, maybe a great idea, but I think it'll be good to have about $500,000 just in stocks, and then I can have about almost $1 million. I think it'll be 900,000 after tax, which will be good. So I think it'll be a good idea to maybe put 400,000 to ETFs just for a little bit extra passive management. So $400,000 for this is our budget, and it costs us $45.26. I'm gonna buy about 8,000 shares of this fund, and then we're just simply gonna reinvest the dividends into whatever I think is a good deal. We may lose a lot of money off this play. We may make a lot of money off this play. I'm mainly just doing it for income. So as of right now, we make about $5,000 off of our interest. We make about $7,000 off corporate bonds, and we make $28,000 in dividend income. So dividend income in this game, like I said in the last episode a little bit, I haven't really talked about it much in this episode. But if we look at this, I'm in a high tax bracket technically in this game now because I'm managing almost million. I'm starting to manage millions of dollars, which is a lot. So now it's a better idea to actually play in my head right now taxes. So if we look at it, corporate taxes, we don't have to pay any of that because we're not a corporation. But individual tax rate on ordinary income. So you may be asking what's ordinary income? Well, ordinary income is, in this game, I'm pretty sure it's dividends and interest. But in real life, dividends are more efficient than interest. So in real life, like I said, like last episode, interest is like basically counted as employment income, so which is like 100% taxable. While as dividends, they're a little bit more efficient. They're in the middle. Capital gains are most efficient. That's why you see me out here buying bonds at a low level, and once they're worth a ton, I take a giant capital gain. It's because that capital gain is more efficient than just actually keeping the bond, receiving the coupons, because those coupons are taxed in this game at 34%. So that's one big reason why I decided to take that $1.5 million gain. Also wanted to settle my loan. Oh, that's one thing I forgot to do in this game, is I forgot to sell that loan because I could be potentially in a ton of trouble if rates rise. Look at this. I forgot to sell this loan. Thank you for reminding me, myself. But in this case, we have $800,000 in loans. We have $1.5 million in cash. How much do we owe in taxes? About $177,000. So we're gonna have a little bit less than $1 million in cash, but we're still gonna have cash to redeploy into more bonds, and hopefully the junk bond ETF we bought does okay. I don't want it to do amazing, but I at least want it to retain value. So I think in this game, once you start hitting millions and millions of dollars under management, it goes into a different way in real life, and also in real life too. You go from trying to grow wealth to retain wealth. So that's a lot of the times that you guys would see me do in my last Speculator series, you saw me, I was worth like $2-3 billion. Near the end of the game, I just bought bonds because I could have bought more stocks, could have took more risk, but at the end of the game, I just bought a ton of bonds because that's the name of the game. Once you get rich in this game, is you go from trying to get rich. Because right now, when we first started, we started off with $100,000. But when we got bigger, the name of the game was basically try to keep that wealth, and maybe grow it at a little bit, but not try to grow it at insane levels. So we're gonna try to sell that loan. See, like right now, we've been growing our wealth a lot, but as we get bigger, I'm going to start going into a bit more wealth retain. I'm going to try to retain my wealth instead of try to grow it. Right now we're in the growth stage where I have about $1.4 million to lose. It's a lot of money to lose, but when we first started, it was $100,000. Your life... Right now, I'm in the growth stage of my life where I want to try to grow my money. I'm acting like I'm acting like a retainer. I've been buying bonds, buying dividend stocks. That's why I want to buy growth stocks more in my future, is because I want to try to grow my wealth, not retain it. Once I do get rich, yeah, sure, it's all about retain my wealth. So later on in this game, we're going to go into the retain strategy. We're going to try to not lose money. I'm going to do hedging, rats, etc., etc. But right now, we're going to go ahead and I'm going to pay back that margin loan because I do not want to forget about it, because I forget about it and rates rise, or potentially going to have to be paying a ton of interest charges. So we owe them $611,000. I'm okay with that. And we could do game sends, and where is it? Sweep cash to margin. So therefore, I don't have to forget to pay the margin. Every time I get big cash influxes, like from my coupons, my dividends, my interest, it's automatically going to be used to pay back my loans, which I like. So in this case, whenever we have any loans anymore, we borrow money, any of the cash flow we receive will be used towards paying off that loan, because this also goes into a thing whether or not it's a better idea to pay off debt or invest. It's a bit of a hard topic because there's two big hypotheticals in life. right now I have no debt, so it really makes no sense for me to ask this question whether or not I should pay off debt or invest. But in this game, we could have kept that. We could have kept like the $600,000 borrowed, and we could have had some debt on our backs. And if interest rates stay low for a while, we're going to do okay. So hypothetically, if let's just say it's 6% to borrow, and maybe I can buy a bond that pays me 8%, then potentially I could offset my borrowing costs by investing. But the big but is that 6% we borrow from, it's guaranteed. We have to pay back our margin guy, you know? For example, if you have a mortgage or you have a car loan, and your car loan, for example, is 7% interest or something, or a very, very high interest rate, I say if it's above 4, then it makes sense to pay it back. Because how are you going to get more than a 4% return? Well, that 4% is guaranteed. Well, that's also what they go through in the Kevin O'Leary video. Is it's also very, very important because if you have, let's just say like that 6%, it's gonna go up over time, but you always have to pay it. Whereas with that bond, it could not pay you. So in that case, you could actually lose money. So if you want a guaranteed payoff, a guaranteed investment, it makes more sense to. Again, it's also not really financial advice, but it makes more sense if you, as a guaranteed investment, to actually pay off debt than to invest. Because if you invest, that you're taking risk when you're investing. Your value could go down. Like let's say I put $100,000 into a stock, and it's paying me a lot in dividends, or I think there could be potentially a lot of capital appreciation. Well, that's good, but what if the value of your stock goes down, the dividends get cut, there goes your income, and you still have debt on your back. So in that case, if you want a guaranteed payoff, it makes more sense to honestly pay off debt than to invest. But it also depends, like what kind of interest rate is your debt. If your debt is very, very low interest rate, it makes more sense to invest. Like right now we're in ultra low interest rate environments. So if you hypothetically, if you go out there and you buy a mortgage and you get a 2% rate, oh yeah, I'm pretty sure I can do better than 2% investing in stocks. Like the bank is basically losing money if it's 2%. That's also if it's a fixed rate mortgage. If it's a variable rate mortgage, I would pay that off ASAP, because if interest rates go up, your payment goes up, and therefore you're in trouble. So So I found that very interesting. It's a bit of an interesting topic. It's a bit of a controversial one because people have different types of opinions on whether or not you should invest or pay off debt. I say if it's very, very low interest rate, like 2%, as long as it's like, I think once it starts hitting 4, 5, 6, 7, 8, and it goes into the 20s, I say pay it off ASAP, because those are guaranteed payoffs. You're guaranteed to actually make money in that case. Whereas when you have a lower interest rate, it's highly likely you're actually going to make a bit more than 2% a year. So if interest rates were very low for a long period of time in this game, I would be borrowing money like crazy and finding bonds and then doing like those short rate bonds. But in this game, it's not like real life. We've been in a low interest rate environment for like 10 plus years in real life. But in this game, there's cycles. Interest rates go up a lot, they go down a lot. And this is what real life was like for a while. Like during 08, 09, interest rates were like this. They would go up a lot to stop people from spending too much, stopping inflation from getting out of control. And they would go down a ton to introduce spending to try to get more jobs, etc. And then whenever they thought the economy was overheated, they would raise rates, lower rates, raise rates, lower rates. But as of right now, we're in kind of low interest rate environment, and we've been in here for a while. So it makes sense probably if interest rates stay low, then it makes probably more sense to invest and borrow. But that's just my personal opinion. If rates do take a big spike and you have a variable rate, I would say pay it off ASAP. But if you lock in your money at a fixed rate mortgage, for example, at 2%, you have a fixed car loan at 5%, It also depends on how long the term is, etc., etc. But that's just a bit of a rant on whether or not it's a better idea to pay off debt and invest. Personally, I don't have one big thing when it comes to law and financial advice, even medicine too. Like, think of me as a doctor. I don't know the answer to everything. Like, I don't know the cure for cancer. I don't know the cure for anything. But I'm just saying, like, it depends. It all depends. I know people probably hate hearing that, but it depends. So that's probably best where you sit down with a financial advisor and someone who's actually licensed and someone who's qualified, and then they can look at your entire picture. Kind of like with a lawyer. Like, if you go over to a lawyer and, like, you wouldn't want to take your lawyer advice from YouTube. Yeah, same for me. Like, you wouldn't take your stock advice. But I'm here to help lead you in the right direction to a certain extent. So, enough ranting. Okay, $790,000 in cash. We have a ton of money in buying power, but that's including our line of credit. We don't want to borrow. And we have about $177,000 in borrowing. And in this case, we have about $790,000 in cash. So we'd have about $500,000 to play with if rates do rise. But right now, I'm just going to keep a liquidity just because I think right now bonds are garbage. Unless I'm doing like short bonds for like 1 or 2 years. But as of right now, I'm just going to keep cash just because I don't really feel like looking out for bonds at the moment. And I'm also going to do my stocks. So we don't have $87,000 invested in a junk bond ETF. We have now I'm just gonna say 481K. Oh, 702. So that's how much we have in a junk bond ETF. And this is how much we have in a. This is how much we have in a. This is a. Just Gov bond ETF. Cool. So we have government bonds, we have corporate bonds. I also might do what else? I might just do more. I might do a corporate bond ETF later on. But as of right now, we're just gonna let time play out. Like in real life, investing takes patience. It takes time to grow your money. If you're gonna think you're gonna play the market and make money in the short term, it's probably better you save your money, because if you play the market in the short term, you could get burned. You know, that burn could be in trouble. Okay. Oh, rates. Ho 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 ho. I'm so glad I took that profit on that bond, because I'm pretty sure I did that bond around here. But rates just spiked because I think oil went up a lot lately. So like that's like oil could potentially have a problem, because as oil prices go up, it costs more money to make agriculture. Your prices go up, your inflation goes up, because businesses have to compete. So typically, as commodities go up, that could potentially be an indicator for inflation. And when inflation typically comes, banks, they really don't have much ways to counteract inflation. They can really just raise rates to stop suspending and slow down inflation. So in this case, whenever commodities go up, it could potentially mean that rates can go up. So right now, commodities are starting to go up quite a bit. Corn's up quite a bit. So I'd say right now that inflation is maybe starting to pick up in this game. Gold typically does well in high interest rate environments, because that's when typically there's high inflation in this game. They don't have anything called inflation in this game, but you can somewhat tell by looking at the commodities, etc. So it might be a good idea to buy gold right now, but I'm sticking to bonds and bonds only. That's the one thing that kind of bums about this strategy is I'm a bit of I like to do everything kind of guy. I like to buy stocks, I like to buy bonds, I like to buy futures every so often in this game. Whereas in real life, I'm a bit more of a stock and bond kind of guy. I don't like to touch futures because they're too high risk, but in a simulation, you can let your mind do anything. You can buy a ton of futures. You can lose billions of dollars in this game, and you're not going to be fired. You're not going to lose. It's just all imaginary money. That's what I like about these simulation games. But that's why I don't really do much simulation games anymore, really, because it kind of teaches you, hey, you can be risky with your money. You can throw away. It's all monopoly money. You can play more risky. Whereas I actually found this actually pretty interesting. I learned about this like a while ago. But a good experiment is if you have a bunch of money, monopoly, but real money. I think it's a TEDx talk.
Are you looking?
Oh shoot! There's an ad. I'm just gonna mute this. A good video to watch if you want to teach your kids about money, and whether or not because the big problem about bank accounts, in my opinion, and this is also coming from Dave Ramsey, who's a personal finance YouTuber, and he's very, very popular on the internet and such. I'm personally not much of a fan of Dave Ramsey. I think he really is helpful because he teaches people how to pay off debt and stuff. So if you're interested in him, his name is Dave Ramsey. Dave Ramsey. He's basically a personal finance guy. He's very helpful. He can help you dig yourself out of debt if you have personal finance problems. So the personal finance is one thing I need to get better at. I'm trying to get better at personal finance. I'm more interested in investing. That's why I've invested in games. That's why I do invest in. That's why my name's called the Canadian Investor. That's because I'm just interested in investing. But this is interesting. Why when money isn't real? The $10,000 experiment. Basically, it's a quick summary. This guy hands $10,000 to all of his kids. Say, hey, go crazy, buy properties. Basically, play Monopoly, but with real money. So the kids who actually were risky, they actually play a lot more careful because they actually knew, hey, this $10,000, they actually hold in the money. It actually is real. So when money is actually real, you tend to take less risk with it. That's why when it comes to my brokerage, whenever I see negative $500, I see negative $500. I see that I lost $500. Well, as in this game, if I lose $100,000 in this game, it's no big deal. It's just a game. I could learn from my mistakes. So that's one of the benefits of doing what I call paper trading, and that's what my old series is called. It's called paper trading. This is just a simulation. Well, as with real life, I try to do a bit of both. I try to learn from this simulation, learn to trim, learn to buy dividend stocks, learn to research, learn to etc. But this is just a simulation. It's not real money. I wish it was real money because I could. I wish I could turn $100,000 in this game into into 1.2 million. But I took a lot of risk again here. Well, as with other series, I just mainly try to learn from it. But again, that was also a very, very interesting video if you guys want to watch.
Okay.
I tend to rant a lot of my streams. That's one thing I like about it is I'm not much of a script kind of guy. I don't like to stick to scripts a lot of the time. So that's why my videos aren't super duper well made. Ouch! That hurts. We lost the money. So now I'm going to start paying more attention to this game. So I'm pretty sure I was right. As when interest rates tend to be high, junk bonds tend to get hurt really badly. But it's vice versa. So I could probably hedge my portfolio just by doing ETFs in this game. I could do government securities at high rates. And then whenever interest rates start hitting low levels, I could do this. I could play around with it. And thanks to that convertible bond, we actually have individual stock. So this is the only thing I'm going to allow is if I want exposure to the stocks in this game, I'm just going to say, hey, I'm allowed to buy convertible bonds, and if I convert them, it's fair game. So right now we have an individual stock. It's National Bank of Greece. Technically, most of their portfolio is in loans, so technically it counts, but it's not entirely bonds. But it's a small amount of our portfolio. So, yeah, sure. If you guys want to count this as cheating, because I bought a convertible bond and I converted it to individual stock, and this individual stock is a bank, and they're not exposed to bonds like this high income one and this prudent investment trust, yeah, sure. At the end of the day, you guys can just say this 20,000 or the amount of dividends, etc. I make off of it. Yeah, sure. You guys can go ahead and count that towards. Let's just say maybe it's $100,000 10 years from now. Yeah, sure. It might count. I'm just saying, if this counts as cheating in some of your guys' eyes, I can sell. But nobody's really watching my stream at the moment, so I'm basically controlling all the cards to a certain degree in this game. But I'm down for if you guys have any suggestions about this series and how I can make it better. I would 10 out of 10. I would love that. So we have about $700,000 just sitting in cash. I'm pretty sure all of our we have no bonds now. So I'm gonna go and get rid of all this. Get rid of that. So now we just have ETFs. So now I think it's about time we start redeploying capital. So I gotta get my game face. Right now, we're gonna see where interest rates are going. Currently they're tightening. But if we look at the short rate, it's starting to have a bit of a flat off period. So whenever I see flatten off in charts, it typically means that rates could potentially go up a lot or they could go down a lot. Typically with indexes too. You see, like this is like a bit of a like a symmetrical triangle, and then sometimes with a symmetrical triangle there can be a big reversal or a big upside. So that's one big reason why in my other series where I did my oil thing, as I saw like a bit of a symmetrical triangle, which is a chart technique thing. Symmetrical. So it's just a symmetrical triangle. Two conversion trend lines, so it's peaks and troughs. These trend lines should be equal shape, and sometimes you can basically predict whether or not stocks are going to fall a lot or go up a lot potentially. Oh, I think it's called continuation pattern. I think that's the one I was looking for. I don't know, but like there's one that I actually am kind of afraid of, where it's basically it tells you that things could go up a lot or down a lot. So a lot of the times I don't participate. If they go down a lot, I participate. If they go up a lot, I tend to not really. And that's when a long short strategy might actually work in this game. But now we're gonna go ahead, and I'm gonna go ahead and maybe actually buy $230,000 in lawn bonds. That is a bit risky because if rates go up, but if they go down, because I'm pretty sure if we look at this, they're flat. So I'm pretty sure that either it's a chance that interest rates are going to go up, or it's a chance that interest rates are going to go down. And I don't like to get completely messed up. So in this case, I'm going to do only $230,000 of my $700,000 will go towards the lawn bond. If it goes up, I'm not really beating myself up because I have $500,000 in liquidity. But if things go down, hey, I make a bit of a profit at the end of the day. So we're going to do $230,000. And it's currently trading at $830 per bond, right? So we should be buying about 277 of these bonds. That is about $230,000 we're going to spend. And we're going to keep the extra $530 in cash. If rates continue to rise, I'm going to continue to buy. If they continue to fall, hey, it's alright. I'm going to go ahead and take this profit. Basically, we're playing both ways. Like, I like this one meme from It's Always Sunny in Philadelphia. It's like, that's where I'm going like with my whole investment strategy nowadays. Is if it I play both sides, that way I always don't lose or something like that. It's a pretty funny meme that I found on the internet. Basically, I play both sides when it comes to investments. I play, because in this case, I'm playing both sides. I have a ton of cash, so if bonds continue to rise, I'm able to lock in at higher prices. But if bonds fall, hey, I make money. So that's why I like having cash when it comes to my personal investments, because if you're just buying stocks, it's great if stocks go up, but if they go down, that's the other side. Hey, you lose money. So that's why I'm probably, but in real life, I'm not going to do long short. I'm not going to do any high risk strategies. If I ever do want to take risk with stuff, I'm just going to outsource it to, well, this goes into another example where we went into last time, where if we look at exchange trade funds right here, I can outsource my work to people and I reduce my risk. So when it comes to aggressive growth shares, I found this interesting because I learned about this in securities class. We had a securities class, and I ended up passing my securities licenses and stuff. I don't really know what that means, but I do. I'm just plain in denial. But I found it interesting because in that class I learned that you can actually buy leverage ETFs and stuff. So by that, I mean like by outsource. I mean like, for example, if I were to go up there and I were to borrow $300,000, or if I was to go out there and borrow $1,000, and then my stock position were to go down a ton, and let's just say hypothetically that $1,000 becomes $10,000 of a margin call because my stocks tank in value, that's a $10,000 loss. And let's just say I only have $2,500 in my account. In that case, I've lost $7,500. So if I lose 7,500 divided by 2,500, I lost 300%. In that case, you lose more than 100%. You lose everything. But by outsource, I mean this company out here, the Aggressive Growth Shares Fund. Let's just see what they look like. I'm not gonna buy it because that technically counts as stock. They have 61 billion, but they have a ton in leverage. So how much do they borrow? Where's their borrowing? Where's their liabilities? Oh, they don't have any debt at the moment. But they could borrow 60 million, $22 million in cash. If they borrow that money, well, in this case, it's indirect. It's an indirect play. That's one big thing I'm a big fan of investing is indirect plays. So if I'm really bullish on whatever is in this fund, I can buy this fund, and at worst, I'm going to lose 100% of my investment. Hey, I'm okay with that. Risk and reward. But if I were to go out there and do it individually, I was taking the margin, I have the control, I could potentially lose unlimited amounts. I could lose more than 100%. So as I get older, as I get more employment income, etc., and if I'm still doing YouTube and such, I'm not going to be doing any like high risk strategies. But if I ever want to do high risk strategies, I'm going to looking at ETFs. I'm looking at leverage ETFs, inverse ETFs, short, long and short ETFs. And I'm gonna let the ETFs. I'm gonna let the institutional investors do all the work for me, and I wouldn't mind paying higher MERs for that more risk and more performance. Yeah, it's like even when it comes to my options, like personally in this game, it's taught me a lot of options, and I'm pretty competent at options, I'd say. But when it comes to real life, that's a whole different ball game. So in that case, I am more of a fan of just outsourcing my work, and I can outsource my work when it comes to bonds, and that's one big reason why I'm sticking to ETFs. So like my number one reason why I'm planning on doing more ETFs in my future is just to outsource my work. So you might be asking why you want to outsource your work. Well, in real life, if you have like when it comes to everything, if you want to outsource your work, you can hypothetically, so like let's just say you're making like $30 an hour as a consultant or as any other job out there, and let's just say you can pay someone $15 an hour to do some menial tasks that you really don't feel like doing, or you're not super duper efficient at doing. Let's just say that you're really bad at painting. So like let's just say that you're really good at what you do. You make $30 an hour, and you're really bad at painting. Let's just say it takes you This is a bit of an over-dramatization, but I want you guys to get the principle. Let's just say it takes you 10 hours to paint the house. That's 10 hours of your physical time. So that 10 hours that you use towards painting the house, that's an opportunity cost. You spent 10 hours of your life. And the big thing is, this is how much your time is worth. It's worth 10 times your $30 an hour. Because you could hypothetically, you could work that 30 hours. You could work that 10 hours that you would have been paid in. So it's like, why work? Why work on painting when you make double that at your job? So it makes more sense to hypothetically work during that time and just outsource your work. At the moment, for me, I'm the outsourcer. Like, for example, I'm the guy who's making $15 an hour. But as I get bigger and I get more and more income from my job and etc., I could potentially outsource my work to people who are willing to make less, like $15 an hour, etc. So, like, let's just say it's 10 times 30. For that 10 hours worth of work, you could have made $300 at your, let's just say you say a manager or something. I don't know what jobs make $30 an hour. I'm young, I'm naive. But let's just say you're a manager and you're making $30 an hour. You could have made $300 during that 10 hours of painting. So, well, but when it comes to that, you actually pay 15 times 15. Oh no, it's 10 times 15, my bad. Just trying to teach the principle of outsourcing. Why I want to do more ETFs and stuff in my life is 10 times 15. 150. So in this hypothetical example, not really financial advice in any way, but like I'm just saying, if you make a lot more than the person who's actually painting the house an hour, and if you actually get those shifts, it makes more hypothetically sense to actually outsource your work. You get other people to do work for you. So in this example, I could, you might be asking, why does this have to do with investing? Well, let's just say I'm not super duper good at biotech stocks. I don't know how to invest in biotech. I don't know how to do any of that. Or let's just say it's like healthcare, etc. Anything that's really, really complicated in nature, or just something I don't understand in general. Like right now, I understand financials and I understand utilities. But I'm trying to understand everything. So when it comes to my personal portfolio, I'm trying to understand Suncor, which is an energy company. I'm trying to understand Enbridge. I'm trying to understand this company, that company. I'm basically trying to be a jack of all trades, and I'm not really concentrating my effort in that one sector. Because if I try to concentrate my effort in that one sector, I can be a pro at that sector. And I'll know what stocks are good deals, what stocks are bad deals, etc. Well, I can outsource my work. So hypothetically, if my Suncor stock does go up a ton, I make a profit, I may end up buying an energy ETF or something, and then they can make all the choices for me. They're going to do all the stock research, etc. And I'm going to outsource all my work. So in this case, that's one big reason why I like ETFs, and they don't teach you in school, basically. I haven't learned that. Well, we learned that professional managers and such manage portfolios, which makes sense, but they're professionals. They're going to outsource the work for you. So instead of you going out there and doing everything. Yeah, so I found that pretty interesting. So we're going to redeploy capital. Interest rates are kind of flat. But we did do that $230,000. Yeah, we did do $230,000 in government law bonds. Awesome. We have about $500,000 in ETFs. That's me outsourcing my work. And when does that government law bond mature? It matures 2052. So I'm just going to do 2052 government. There. And if rates continue to rise, we're going to go ahead and buy more of it. So that's why as I get older, I want to try to outsource my work a little bit more. So now we're going to see if interest rates continue to rise. If they continue to rise, I'm going to buy more bonds. They've been kind of flat lately. It looks like there's a constant uptrend. That's good. Yep, uptrend. There's been a bit of an uptrend, but not considerable. But it's going up. It's going up. Oh, it went up a little bit more. So if hypothetically, if interest rates went down in this situation, I would still make money. That's why I'm playing both sides in this game. It's because I like having cash and I like having investments. So I'm okay with making less of a return by having cash. Okay, so I'm gonna probably lock in 100,000 at the long bond. So okay, so we have about that. I have about 509,000. And our government bonds, we lost about $50,000 in that government bond. So I think we locked in at let's say we locked in around 7% long. So hypothetically, we have about 250K invested at 7% long. So if the government bonds go below 7% long, we make profit. So I'm pretty happy. But right now it's at 8%. So I might want to do $250,000 of the long bond at 8%. Who knows? But like I'm just basically doing a bit of simple math because like if you think about it, about $250,000 at 7%. If I sell right now, I lose money. But if rates go down to below 7, well, I'd probably make money off that long bond. So I'm gonna probably do 100,000 of the long. I'm just slowly gonna buy up. So I'm playing both sides right now. Interest rates are higher. They're at 8.24%. I'm gonna buy $100,000 worth of this bond, and it's 725 for that bond about. So I'm gonna buy about 137 of these bonds. That's almost about 100,000. So we bought an extra $100,000 for bonds, and as interest rates continuously rise, as they rise, I'm gonna continue buying more. And in worst case scenario, if they continue to rise, hey, we have our coupons. We have government bond interest of $21,000 rolling in. So if I do that, hypothetically they pay semi-annually, but if I do 21,735 divided by 12, a lot of the time, in order to get a clearer picture, you gotta do monthly. So every month I'm making $1,800. That $1,800 could be reinvested back into bonds at hypothetically higher rates. So if the long bond does go to 20, and I've seen it go to 20 in this game, if it does go to 20, I could buy 1.8K at 20%. Hey, I'm making off like a bandit because I'm getting benefits on both sides. So like, that's one of the big reasons why I like incrementally buying at higher rates. So that's why I'm keeping some liquidity, because if bonds do go to 20% and I have 400K, oh my gosh, I'm gonna make so much money. But if they do go down from this level, I still make some money because I'm buying 100K increments every 1%. So I'm happy. You don't want to be too greedy. That's one big reason to take away from what my bond approach is and my investment approach when it comes to this game, is a lot of times you don't want to be too greedy. Like, I've been investing since I was 16. I did it like my mom's account and such, but you don't want to be too greedy, because like when I was young and I was a young investor and such, I took a lot. I was kind of greedy. I did a lot of speculative stocks. I made some good profit on some stocks, never took it, and then stocks tanked or the economy decided to go back down. Great quote, what must come up must come down. So if stocks go up a lot, you could potentially lose a lot of that. So sometimes it makes sense to actually take profits out of your stocks and then just put your capital towards cash, maybe whatever you want, like paying off student debt, etc. But you just don't want to be too greedy. You don't want to have like, that's the one problem I have when it comes to in real life money. Like in this game, I have no greed, I have no fear. I'm just thinking 100% rationally, 100% big brain. But when it comes to real life, I have greed, I have fear. Right now, I'm a little bit afraid of a correction, because I think stocks are expensive right now. And past me, I would have probably been more greedy right now than ever. But part of me is thinking, it's a 50-50 chance maybe in the future. Or I don't know when stocks are going to crash, but when they do crash, they're going to crash hard. And if I didn't keep any cash, I'm in trouble. So you one big thing what you want to do is if you're an investor is try to manage your greed and your fear. Your emotions, your psychology is one of the most important things. So that's why one of the things I'm actually interested in besides finance is just psychology. Understanding like your mentality in life. So we bought about $100,000 with these bonds around I'm gonna say 8.2%. So I'm just keeping this for like a bit of a mental reminder, just to remember myself. Hey, you want to sell all your bonds when they go below 7 because you could hypothetically make a profit. Just keep that as a mental reminder. Oh, lead-in indicator perhaps. So all the things I say, I maybe don't go into too much detail. So if I say leading indicator, for example, this is basically what I mean. A leading indicator is a measure of something. So example, stocks are a leading indicator. So typically whenever stocks crash, it means potentially something bad in the economy could happen. Stocks could be, the economy could be potentially fine, but stocks being a leading indicator, you could potentially tell that something is wrong with the economy, potentially, when stocks crash. So in this case, stocks crash, and they're at 8%. So maybe investors were scared because interest rates are high right now. So it might make sense for me to lock in more into bonds right now because interest rates might fall because there's a leading indicator, and so like oil not doing that well, silver went up a ton, gold went up a little bit. Commodities are quite high, but there's actually some downward pressure in commodities. So maybe inflation is actually starting to slow down a little bit. Or maybe it's about to just pick back up. So maybe in the next few months, like the next 6 months or so, there might be a recession, there might not be, because of the stock crash. People probably have less money. So in this case, it's at 9% now. Right? Short rate continues to rise. It looks like it's starting to slow down. Okay. So now I'm going to go ahead and be a little bit more aggressive with things. We're going to do an extra, I'm going to do 150,000. We're going to play way more aggressive now. I'm probably going to do, let's just do 200,000. It sounds like I'm just throwing away money, but I kind of have a general sense on where I want to buy. It's a little bit hard to explain, but I'm basically incrementally buying, and as rates go up and up and up, I want to buy more and more and more and more. So in this case, I'm gonna buy 200,000 because that's what I'm comfortable with, and if I get 9% on this 200,000, I'm happy in this game. Because I have never seen the rates this high in this game in a long time. It's been a while. So if we do 200,000 divided by 6, 3, we should be able to buy 350 on these bonds. Right? Almost 200,000. My bad. So we buy around 200,000 at what's the current rate for these? Like 9.6. Yep. So like I'm doing the get rich slow technique. I could probably take on a lot of risk, but I'm more of a get rich slow kind of guy. A lot of people I talk to around my age, like they're all short minded. In this case, we're slowly increasing our bond stakes. If bonds go maybe 11 or 10, I'm gonna buy way more. Oh, here we go. Here's some good news. That's why I keep cash. As rates rise, banks tighten lines of credit for corporations. This is my favorite thing to see because when banks are a little bit more picky on who they lend to, that makes the supply and demand. So there's less supply of loans, but there's a lot of demand for loans. So it means that interest rates are going to continue to shoot up. Supply and demand. So in this case, banks are being a little bit more picky with who they lend to. So hypothetically, interest rates should continue to rise. So maybe around 11 or 12, I might buy more. Now we receive. So right now we're receiving $38,000 a year. So in monthly terms, 38,272 divided by 12, we're making about $3,100 a month. But most bonds, they pay semi-annually, so it's better to think about them as this way. Because semi-annually means twice a year. So we're making about $19,000 every half a year. So in that case, we're making a decent amount of money off that. So it keeps going up. Maybe around 11, I'm going to do an extra 100,000. If they ever do go to that high. Oh, short bond is going up a lot lately. It's starting to soften out. Go up a little bit. Yeah, it's a little bit volatile. Short rates are a little bit volatile right now. They're going up and down. So I'm pretty sure the central bank probably has decided that they don't know where they at the moment. I'm pretty sure. I'm trying to think what the central bank is thinking. They're raising rates, they're lowering rates. They don't know what to think. And GDP is currently booming. So I'm pretty sure that I'm thinking that rates may fall or they may rise. I have no clue at the moment because it's been kind of flat lately, the short bond. They may rise or they may fall. So that's where I'm going to be playing both sides. Is I have a ton of money in bonds at the moment, government long bonds. Our average cost is $73 a share. So that might be good to consider before we sell. But I've seen them go as low, as high as $130. Okay, so now there's been a bit of a downward trend. So if that downward trend stays, it may be actually a good idea to block in more of my long bonds at the moment. So in this case, I'm going to probably take a bit of a risk. I'm going to go 230K at 8.99%. And then if rates do rise, we get our coupons and we reinvest them at higher rates. Worst case scenario, or best case scenario, rates continue to fall, we make bank. But if they do rise, our bond portfolio is going to get hurt quite a bit. 230,000 divided by 677. About 339 at $67. So that's, we're also doing dollar cost averaging. Well, it's technically not called dollar cost averaging. Dollar cost averaging is contributing every month towards the stock, but we're just lowering our average cost basis. So whenever your stocks tend to fall a lot, it may make sense to buy more of them. If you buy more of them, that's you're averaging out your cost. So let's just say you buy like 100 shares at $100, and you buy 100 shares at $50. That's going to average out your cost to maybe $75. There's a bit of math when it comes to that. That's called calculating your ACB. So it's just like you can just like calculate your ACB. So in this case, we have our adjusted cost base on our bonds is $73, and with them being 67, that should average out our costs. What? Oh no, we're not buying bull bonds. My bad. I should really increase my bit rate. 339. So in this case, we're gonna borrow about $3,000, I think. Yep, borrow $3,000. We have a ton of money in government bonds right now. I'm just trying to teach a principle. So we averaged our cost from like $72 to $71. So we lowered our cost of our bonds by $1. Woohoo! That means that if the cost rise a lot, we could potentially make bank. So right now we could get hurt. Because if rates continue to rise, our losses are going to go up. But if whenever they do go into a lower interest rate environment, oh, I'm going to be so happy. It's going to be hype. So right now we have big L's on our high income fund and our things. Yeah. So if rates rise, we're in quite a bit of trouble because we've invested almost all of our money in government lawn bonds, and if rates rise, we're in a bit of trouble. We're not really playing both sides at the moment. That's just because I saw a bit of a downward trend. So I'm pretty sure that rates may fall or they may rise. If they do rise, I'm in trouble because I don't have any cash to play with. But if they fall, I'm happy. And they're starting to fall. Now we're doing well. We're doing well. It would have not been the end of the world if rates rose a lot higher than they were, because I could have just reinvested my cash flow that I get from my bonds back into them and lower down my cost basis. Right now we're making 56K a year. Well, that's before tax. Right now we're making, after tax, we're making about 58K. So at 58K, we make a year. If interest rates did go up, we'd be able to buy 58K at maybe, let's just say hypothetically bonds go up to 20%. I'd be able to buy 58K at 20%. I'd be happy. But if I was messing around with a smaller size portfolio, that's when I really don't have strength. Because if I invest 100K and I get, it probably makes more sense to do this. So 100K invested in lawn bonds at maybe, let's just say 9%, we'll make about $9,000 a year. Whereas if I put like $1 million in lawn bonds at at 9%, we make 90K. That 90K could buy 90K worth of government bonds, and that $90,000 worth of government bonds at 9% is gonna make me $8,100. Whereas at $9,000 in government bonds, we can basically compound our interest a lot faster with higher numbers. So like that's one thing I don't really have as much compound power, because in this case you make 810. So you can't even buy one bond with your interest that you receive. So it's a lot harder to compound when you have smaller amounts, because in that hypothetical example, at 100K at 9% made $9,000. That $9,000 that we made in government bond interest, if we lock that into another 9% government bond, we make about $810 a year. That $810 a year could not buy us a bond, because I think you need at least $1,000 in order to buy a bond. So in that case, we can't compound on compounds. So it's a lot harder to compound when you hit bigger numbers. So that's why when I first started, I had less growth, as you can see. But now that I have a bigger amount of money invested, it's a lot easier for me to compound in this game. So that's what I like about having big numbers in this game. It's a lot easier to compound. And that goes for real life too. It's a lot harder to compound typically when you're a small investor like myself. Like every month, every time I get a dividend, I'm making like $50 or something. If I had a no fee account, I could buy one share. But I have to pay commission on that, so it makes sense for me to do deals in $500 increments. So I really have to start making $500 a month in order to start really compounding my wealth really fast. So that's just one of the principles I found kind of interesting. Typically, I think the more assets under management you have, the faster you compound. So that's probably another reason why you want to have ETFs. It's because they have more assets under management than you do. So therefore they get like, I think that's what it's called, scalability. There's more scalability with ETFs than with me, because I'm a small guy. Okay, so as interest rates continue to fall, we make bank. We have $190,000. And I could have took out leverage, but I might stop using leverage from now on. That $56,000 is going to stay flat. We're going to make that much every year. So I don't have to sell these bonds, but it will make sense if interest rates continue to fall, and they fall, and they fall. It may make sense for me to go ahead and take my profit. Especially if I think rates are going to rise, because they're kind of starting to flatten out. Which is kind of scaring me, because we could potentially not make a profit off our bond portfolio. They're still easing, but as you can see with the short bond, maybe the central bank is wrong about something. Because they're not right 100% of the time. Rates are starting to kind of tweak up a little bit. So I think the market is thinking potentially there could be more inflation. And so that's why I think that rates might be going up. That's the one thing about the game. They can say easing on the interest rate thing, and they're wrong some of the time. Most of the time, they're right. But in this game, they can be wrong. You can say easing, and interest rates can go up maybe 2-3%. But in this case, I was just down myself. Oh, here's a good sign. grow more aggressive in lending. So in this case, supply demand. You think about it, they're growing more aggressive. They're willing to hand out more loans. There's more supply of loans. So therefore, interest rates are probably going to continue to go down. So do I play cocky? And oh no, it's probably too late. Yeah, they tanked. I was thinking, do I take leverage? Maybe, because unless I know I'm going to make like 100%, that goes into risk too. Like if I think I'm almost guaranteed to make money in this game, which in real life it's almost hard to make guaranteed returns. I could have probably borrowed money in that case, but I could have probably borrowed money at 5%, bought the long bond at 5, but nope, I'm not choosing to do that. I'm probably gonna stop taking out leverage from now on. Okay, short bond hits about 1%, so this is when in the game I decide to go ahead and maybe exit my bond positions and keep cash, or maybe take out my profit. Cause I have about $500,000 just sitting in profit, but it'll probably make more sense in this game for me to take my capital gain than, like I said, with the taxes coming into the example, because we have a lot of AUM. Like we have about 1.5 million that we could be taking out right now. About 500,000 of that being gains. We can hypothetically keep that for income. We can make it 56K a year, but I think it's more efficient in this game if we were to take out a capital gain, because capital gains are at 27%. Well, is that $56,000 we make a year, right? That's before tax. With tax in consideration, we're pay. Oh, no, that's not right. That's 3.4%. It's $56,000. We're getting tax and 0.34. So we're paying about $19,000 in tax every year, just to have the privilege to make interest. Whereas if I take that $500,000, right, and I take that as a capital gain, and I just got paid 27% on that, so it's $135,000. So if I do 26,000, whatever, that's $26,000 in tax a year. What is that correct? I'm pretty sure. Okay, I'm just gonna write this down. It's probably it's hard to keep a mental reminder for everything. That's just my bad. 2.7. So like this is a hypothetical example where you can basically determine whether or not it's a better idea to take your capital gains or not. So $135,000 is in capital gains tax. And then if we look at this, we have about $56,000 a year we're saving in interest, and that's taxed at 34%. So we're paying about 19K. I'm just going to say interest tax because it's considered ordinary income. So in this case, if we do, for example, 19,000, whatever, I'm pretty sure if you divide this, we do 135,000, divide that by 19,040, at about, so like, in order for it to be more efficient as a source of income, this is basically 7 years. The capital gain, this is basically 7 years, I think, of interest taxes. So I like to think of it as, right now would be a good time to take out profit of my bond, because it's 7 years of interest taxes. Basically in this case, 19,040, right, times the 7 years, that's about 135,000. So in that case, over a 7-year period, if we keep receiving interest, it'll be good. But over time, it potentially might make more sense in this example to actually take out my capital gain, pay $135,000 in capital gains tax right now, and that way I have some cash to play with. And if rates do rise, my bond portfolio isn't going to get hurt. I have to kind of know about this a little bit more on whether or not it's a better idea to take out, take your profit on bonds. So like this is one thing I'm going to leave for myself as a mental reminder is whether or not it's more efficient to take out capital gains from your bond, or whether or not it's more efficient to actually keep it for the income. So in this case, if I'm making 56K a year in income, it might make more sense over the long term for that for the 56,000 whatever I'm making income minus the 19,040. I make about $36,000 a year. So like this is like how much I'm making after tax. So if I hypothetically, if I do $135,000 in after tax gains, and I do by 36,960, so that's about 3.5 years, 3.65 years. So I think if rates stay flat for 3.65 years, it actually might make more. Or if rates stay flat for 4 years plus, then it actually might make more sense for, if rates stay flat for 4 years straight, it might make more sense for me to keep the bond for income than to take capital gains right now. That's basically what I'm trying to ask myself, is whether or not it's more efficient for me to keep the bond for income, or whether or not it's more efficient for me to take my capital gains right now. I have no clue on really how to calculate which one would be a better situation. I'm trying to do that right now, but I'm not 100% sure. But I'm pretty sure, with me coming into consideration, 4 years is a long amount of time, so I'm probably just going to take my capital gain on this bond and not keep it for income, because it's got higher tax rates on income. And I'm pretty sure in the next 4 years, rates are not going to be flat. Like, if they are flat, I lose a lot, because that analysis, I'm pretty sure if rates stay flat for 4+ years, it would actually make no sense for me to take a capital gain on this bond. But I'm going to go ahead and look at our capital gain real quick. It is worth... Where? Oh, that's my stocks, my bad. Make about $500,000 in gains. So I think that's my best, trying to come up with like whether or not it's a good idea to keep the income from the bond or to take a capital gain. And I'm pretty sure it's more efficient in this game to take a capital gain, or at least in this exact scenario. I don't really know, but I gotta know how to analyze after tax a little bit more. So I'm gonna probably have to memorize a bit more of taxes and stuff. But I'm pretty sure it was a good idea for me to take that giant capital gain. And now I have some liquidity. I have $1.4 million just sitting in cash. I can play with this now. I can do whatever I want. Well, it's with that interest, I'm making 29,000 after tax, I think, or 36,000 after tax. And that money would be nice because it's coming to me. And I just have continuous cash flow. But I think it was a good idea for me to take that gain, pay a bit of tax on it, and just have that in cash. I think it was a better idea for me to take a capital gain on that bond than just receive coupons, in my opinion. But if rates stay flat for like years and years and years, I think that capital gain was actually a stupid idea. But watch it, rates are probably going to go up. So like, I think, at least for myself, I think in this, when it comes to this, if rates stay flat for years and years and years, it probably makes more sense just to keep your bond for the income, and you could actually probably make more. Yeah, I think that makes more sense, because if rates were to stay flat for years, you're making your continuous income. Well, as if you take a capital gain, it's just a one-time payment. It's kind of like lump sum versus. It's kind of like your lumps, whether or not you should lump sum invest or just continuously invest. Because that $26,000 could have been reinvested into stocks, etc., or the bond fund that I have in this example. It could have probably paid off a lot more. But I see potentially in the next 5 years in this game that interest rates are going to go up. So I think it would make more sense. If rates were to stay flat for 4+ years, I think it would make more sense just to keep the bond for income. But who knows? That's one thing I got a little bit better at. Just go my phone real quick. Okay. So now I'm probably going to do a little bit less explanation. I'm just going to say, hey, this is important. Things are going up. Our stocks, we still have a loss on our good old high junk bond index, whatever. It's a buy right now from analyst. We have a lot of liquidity. Dividend is 4.5%. I could probably average down my cost basis. So like I think this might be a bit interesting to do a bit of math on. I'm pretty sure I know how to calculate how to adjust it, how to calculate how much adjusted cost base you can get. So in this case, I have about 453,000. Oh, I have about 10,000. Okay, so I'm gonna try to figure out how many shares I have. How much? So we got an average cost of $44.71, and we have. Basically, we have 10,918 shares. What if I hypothetically, in this example, I'm going to go out there and I say, like, let's say I have $100,000 I'm willing to invest in this fund to lower my cost basis. 100,000, and the current price is 41.57. In that case, how many shares would that buy me in this example? I'm trying to calculate like my adjusted cost base if I were to buy more right now. I have $100,000 I'm willing to invest at 41.57. I can buy about 2,405 shares. Oh, that's not 3,000. That's cool. Okay, and I'm pretty sure you just add that to your pool. So then we do the 2,405 plus your 10,918. You get 13,000 shares. Right. Oh, and then you divide by the cost that you actually put into them. So I'm pretty sure like the total cost of this transaction was it's 44.71 times 10,918. So this is how much our this is how many shares we're gonna have if we do this transaction. I'm just trying to calculate my adjusted cost base. Like how much am I gonna lower my average cost if I buy more shares right now at a lower level? So we have that much shares. How much did we originally buy it for? Bought it for 44.71 times 10,918. So we bought about 408,143, right? About 78. 78 probably doesn't matter. Like that's how much we originally put in. So I'm pretty sure in order to calculate like your adjusted cost base, you just do your $488,000 original investment plus your additional 100,000. In that case, it would be this much, and we divide it by 13,323. That's how many shares you have after if you hypothetically buy. So it might not make sense to buy 100,000 shares, $100,000 worth, because we'll only lower our adjusted cost base to $44.14. So we lower our ACB by so in this case it would be 44.71 minus 44.14. We're only going to lower our adjusted cost base by 57 cents, but if we hypothetically buy more shares in this example, it would lower our adjusted cost base. So I'm pretty sure if we just double the amount of shares, we could just like half our cost base by like a few dollars. So it could mean potentially a lot if the stock does go to 50. So we have a bit more of a chance of making profit if we buy in at this lower level. That's why I think Wall Street bets, they make the joke, buy the dip, buy the dip. So in this case, I'm going to buy the dip. So I'm going to put an extra $400,000 into this fund. It may be a stupid idea, because if the fund continues to go down and go down and go down, it's really going to burn me. So in this case, I'm going to, I need to look at the ask, my bad. So if we buy an extra 488,000, and we divide it by $41.61, you know, I'm going to trim if I make a decent profit off this fund. So we buy about an extra 11,731 shares. So watch this actually lower my cost base. I'm actually going to run that up. So if we look at this, our cost base, it went from about $44 to $43. So our cost base actually went down about like $1. So if our shares go up $1, we're actually closer to breaking even now because we bought the dip. But the big disadvantage about buying the dip is maybe those shares were down there for a reason, and they're going to continuously fall and fall and fall. So that's where buying the dip could potentially be a problem. But like this stock has been mostly flat lately, so unless it does like this where it goes to $30, I think it was a good idea to maybe buy the dip, and if it goes to like around 50 or so, I'm gonna make bank. But I don't know, it might be a good idea that I bought the dip in that case, especially if the price goes above our break even, basically lower. So that's one reason why I like buying the dip. I deal with Manulife stock in my past, and I did pretty well in Manulife just because during fear I bought the dip because it's a great company. So that's why I thought I think it was a decent idea that I bought the dip on the high income fund. But if it continuously falls, we lose money. And you might be asking like, oh, what if the stock fell a lot more? If I double my adjusted cost base on that, like what I did with this, my lower, I would be able to buy more shares at that lower level, and then I would have been able to lower my ACB by like a lot. That's why it's a good strategy, because like if you find a company that is fundamentally sound, like when it comes to stocks or bonds, but like mainly stocks, if you find a company that's fundamentally sound and you think is very undervalued, and the market makes it even more undervalued, it makes sense to buy more of that at a lower price, lower your cost base, and then once it starts hitting your price that you're thinking it's worth it to sell because you make a bit more because you lower your adjusted cost base. So like that's why what I did in my older series is a lot of the times whenever I would receive a dividend and my company I thought was cheap, I bought more of it at a lower level, lower my adjusted cost base. Therefore, whenever the stock did go up to where I thought it was worth, I ended up selling it and I made bank. So it was a lot of fun. Okay. So right now we have like $800,000 just sitting in cash. And interest rates are, they tanked. Just recently. Boo. Okay, I was not paying attention. That was my bad. So right now we have about 913. Okay. Yeah, that prudent bond ETF would actually be pretty good too because it's probably a lot more stable. Might also be a good idea to buy that corporate bond ETF maybe. Yeah, I kind of wish I bought more bonds then, because like interest rates are continuously to fall. I should have been paying attention to like that short-term increase in the rates, but it was such a short-term increase. It went to like 6% and then it crashed. The reason why I like having these stocks, even at low interest rate environments, is I'm still going to be receiving dividends. I'm going to receive dividends off these low things, and they're doing most of the work for me and picking everything. So that's why I'm more of a fan of like this whole ETF strategy. So I'm probably going to just do that for now, and I'll keep like maybe $500,000 just in liquidity, and I'll go ahead and buy up some lawn bonds whenever I think it's a good deal, and I'll just keep doing that. But I'm gonna continuously, once I'll use my dividend income, which I think is more efficient, at least in real life. I'm gonna use that towards basically building up my stake in more bonds in the future. But I'm basically just going to be using these bond funds as a ways of having a bit of potential for capital gains, but also having a bit of a way of making a bit more passive income where I don't have to consistently go up there and say, I think bonds are a good deal, I'm going to buy up a lot. Oh, I think bonds are overvalued, I'm going to go ahead and sell them. So that's why I'm going to be doing a little bit more ETFs right now, which technically don't count. I'm going to do maybe 300,000 in that. It depends how much. I was going to go check, though, how much tax we approximately have to pay, because that could potentially hurt us. High income fund. We're looking for this blue chip ETF. I think this is going to be like my go-to. That's going to be like my go-to ETF. That's going to be like where I want it to be most of my money in there. $800,000 in there. We have to pay about $175 in taxes. No biggie. So, keeping to my word, I'm going to do a bit of research on this fund, see how it's managed. A lot of money in corporate bonds, but quite a bit in cash. So if rates do rise, you're going to be able to buy more corporate bonds. It's at book value. Typically, if it's above book value, it's a little bit overvalued. If it's below, it's actually a good deal. But it's maybe down there for a reason. I think it's about 5% in dividends. So it's not bad. Payout $1.47. Research. They're saying it's a buy. If I look at the company, where is it? Company info, portfolio. So they have a 6% bond, a FAR, 0.9 convertible. That's kind of bad. That's convertible, which is nice. And they're going to do most of the management for us, which is nice. Yeah, so I'm going to put maybe 300,000 into this, and I'm going to keep 500K in just cash and liquidity in case I find another good deal. So I'm going to put like 300K in this. And we're just going to use our dividends towards building up our cash base. We're going to start building up a lot more liquidity from our income. Use our income towards building up our liquidity. So we're going to buy 10,000 shares. So we're going to buy that much. So in this case, we have about $500,000 just sitting in cash. That $500,000 is just going to be kept in cash for now. I might do some. I may end up doing a bit more bond layering in the future, because if I have like a ton of liquidity, like if I have like 10 million plus, I think in cash, then that's when I'm going to be doing bond layering, because the interest is actually going to be making me a lot, and I'll be able to buy whenever I think it's a good deal. So I think as I get bigger and bigger, I'm going to be doing more bond layering as a strategy, just to counteract opportunity cost. Because right now, currently, it probably makes more sense for me to keep money in cash instead of spending my time buying a $100,000 bond here, a $100,000 bond there, making let's just say I buy a $100,000 bond and it pays 5% coupons a year. It's only gonna be paying me $5,000 a year. But if I have like $10 million in bonds and it's paying me 5%, I'll be making $500K a year. So I'll be able to consistently make cash flow, and then I'll be able to consistently make buys into more bonds that I think are undervalued. But as of right now, I think it makes more sense for me in this game to just keep this in cash. Once I start hitting bigger numbers, I'm going to start doing bond layering as a bit more of a strategy. I could do it right now. It would probably make a lot of sense to do, or at least maybe like a little bit. Like maybe if I can find like a very, very liquid bond. I just did it. I did it during the start of the game just to show a strategy to people. So the current year, I've really forgot about the years. 37. So if I can find maybe a 2038 bond, hey, get some extra coupons. That wouldn't be nice. That wouldn't be bad. So this bond, it matures in 2037. Might as well buy a shit ton of that. We might make a little bit of coupons. We might lose a bit, but we will make a lot. Matures this year. I'm guessing matures very, very soon. If we can find a 2038 bond, I might buy like 250k worth of that, and if I find any good deals, I'm happy. 2038. Like, this is the one big reason why I don't really feel like looking out for bond ladder strategies. Because as of right now, I kind of wish there was an ability to actually filter these bonds. And one thing I was actually thinking about yesterday, or like a few days ago, was if the creator is watching this video, pretty unlikely, but if he is, I think it would be great if we had sandbox mode where you can actually make crashes happen or weird events happen in the game. Because if I can make weird events and such happen, then basically I can mess around with, oh, what if my entire gold portfolio, what would it do during hyperinflation, hypothetically? Or this. I can play around with the sandbox mode for days, and I think that would be potentially good for content creation for me. Office Depot. Oh my gosh. Okay, this is probably a stupid idea, but I think Office Depot, their bond is potentially undervalued a lot. What is their bond trading at? Let's look into it more. 2039 pays about 12.99% in coupons. It's an A bond during low interest rate environments, and it pays into 2039, which is about 2 years. Screw it, I'm gonna put my entire 500k in this. I know that sounds a bit dumb, but it pays about a 13.5% coupon. And matures in about 2 years, and I'm paying $103 for it. So I think this bond is very, very undervalued due to the market. I am so glad I found this. So it's about 1030. So what about 485 bonds of this? I actually might use a bit of leverage. Let's just buy 500 of these. So we're gonna buy 518,000. We're gonna borrow $6,000. In this case, the corporate bond is going to pay me $67,000, but I'm thinking that this bond is very undervalued. Cause basically my main thought process behind the bond is, it's going to pay me 2 years. Let me just look at the yield. So it's currently a 13.5% bond, which is great, but it's a little bit above that, so it's premium. But like for that $500,000 we bought, we get 0.1173 whatever. So we make about 58k a year, and we get that for 2 years. So it's about 117k a year we're making. And if we hypothetically do like the 3.70, we're paying for a bit above the bond times 2. Paying that much, and we also bought, how many bonds did we buy of them? We bought 500 of them. So we paid this much in premium, and we're making like 100k. So I see it as a potential spread. So in this case, we're making I think we're making about 114k in interest minus the 3700. We're making basically that much a year in interest, and it's during such low rate environments. I think this bond is very, very undervalued, and it's an A bond. If it was a junk bond, like in the double Bs, I would never buy this, but it's also a short bond, which kind of sucks. I kind of wish this was for a longer period of time, then it would have been like a complete steal, but it's for 2 years, so it's not that bad. I think that Office Depot bond, very undervalued, at least in my opinion. Yeah, oh, that's the stock. That's my bad. Bond, 102. I'm gonna continuously buy more and more Office Depot bonds, just because I think they're still undervalued. Especially if it starts hitting par. If it starts hitting around $100, I'm gonna buy more of it. I may even leverage it around 2038. I may leverage it. Kind of wish I bought more of it at lower level. Kind of wish I could probably leverage this bond and just be perfectly fine. Actually, I'm gonna go ahead and try a strategy. Like, this is why I wish we had a sandbox mode. That way, like, oh hey, if you had like a cheap bond mode, like where like bonds are trading at very low coupons, I could play around with like these hypothetical scenarios that I'm going through right now. So right now, this is like a one in a million chance, or like basically the opportunity of this is very, very low, and so that's why I like having the save button is like just save it. So now I can do this hypothetical example. We're gonna buy a crap ton of this bond, like a crap ton. We're gonna try messing around with a bit of leverage. That's why I saved the game. This may not work well for us, especially if the bond value tanks. But in this case, I think I found the prime example of whether or not it's better to take out debt or invest. So in this case, we're double B, which sucks. We have a lot of risk where most of our portfolio is now one bond. So it's a bit of a fun hypothetical scenario. That's why I'm doing this. But in this case, we're paying 6.5% in government bond interest. Wow. Wow. Where is it? This bond is paying us about 13% yield. So if I do some basic math, 13 minus 6.5, I'm keeping about 6.5% for myself. That's a pretty big profit spread. But I'm hoping that rates stay flat for the next 2 years. That way I can take up fully advantage of this situation because I borrowed money for it. But if rates rise, that's going to hurt the value of my bond. I may end up getting margin called. So this is a very, very high risk strategy. But if rates stay kind of flat for the next 2 years, this strategy could potentially work well for me. So let's go ahead and see how this hypothetical example plays out. So if I look at my cash flow, that might be good to look at. $289,000 is going towards my my corporate bond portfolio. $59K coming from dividends. So I'm gonna keep that. If my portfolio doesn't move very much, I may end up selling out some of my stocks, like my ETFs. So we're making about projected. Okay, so we're making about $357,000 a year total. That's including my dividends and my interest. Mine's $90K for interest. And then we got and we're also going to be paying off, how much are we going to be paying off? If interest rates stay flat, I'm happy. Because in this case, we make $357,641 a year. Minus our $91,916. We're making about $265,000 a year in interest. Or, that's how much we're making a month. If I'm using that per month, I'm paying off my loan slowly over time. And then therefore, it's going to decrease my interest. So the profit we make, we're going to be sweeping back into paying off our debt. So as long as interest rates stay flat, we're going to be paying off our debt with our profit, and we could potentially be making quite a bit of money off this deal. But like I said, I wouldn't be probably doing this in real life because there's a lot of risk when it comes to it, and I'm basically pointing out all the risk. The big risk of this transaction, most of our money is in this one bond, so that's diversification risk. We have diversification risk. We have interest rate risk. If interest rates rise, that hurts the value of our bond, so we could get margin called. But as long as we pay our interest, we should be fine. So, as long as we make 6.5%, I think interest rates would. I think I would have to probably go to 13% on my prime brokerage. So right now we're paying 5.25%. So our government bond is paying us. Our corporate. That's important to know too, because they could default. That could potentially bankrupt us too. We have a lot of potential risk with this transaction, but just because this is not real life, this is a simulation. I can play around with things. 2.5. We're making about 7.75% a year. That's 7.75. 0.0775 times 500K. we're making about 38K in profit. Now we're going to use that towards just basically paying off loans. We can use it whatever. And it's semi-liquid because it's 2 years out. So I think that was a good deal. Who knows? If interest rates go up, or potentially if there's more risk that come up, like the company goes bankrupt. But I think the risk versus reward on that situation is very, very low. That's why I ended up borrowing money. If I saw the risk was high, I would potentially not took out leverage. But I see it as a good deal, at least for myself. So we're gonna go ahead and see how this transaction works out. We're just gonna watch it every so often. Okay. So we're just gonna wait out. I actually may end up slowing the speed down a little bit, just because I want to see how the situations work out. So as long as interest rates stay low, we're fine. If they rise, we're in trouble, because it's gonna hurt the value of our bond, and we may end up getting margin called. But I think the good thing about it, we have a bit of cash to play with. Like we still make a profit as long as our prime rate doesn't go above 13%. We're all right. I think as long as we pay off our interest, we're fine. But we could potentially be margin called. Like I'm pretty sure if you pay your interest on a loan, you're all right. But sometimes you can get margin called. I definitely know with a mortgage, as long as you pay the interest, you're not going to be told by the bank, "Hey, we're going to foreclose on you." As long as you're paying the loan, you're fine. But if they see like your value tanks in price, they can't just say, "Hey, we want to take away this from you," because they take on that risk. Or at least that's how I'm interpreting things. I could be wrong. So this is like a big bet we made. Seems like rates are staying flat for now, which is good. Still making bank. Minus our interest, we're still making bank, and we're expected to have after-tax cash flow of $175,000 a year. That's pretty good. And potentially, I think I can write off the interest on this case, in this game. So this is actually a really good transaction. As long as whatever I'm thinking about risk is, as long as the risk remains low. I think it's going to be very low for now. A lot of people my age, they don't consider risk a factor. Like GME to the moon, GME to the moon. You're considered a lot of risk with that. Like, look, risk is starting to go up now. My spread is starting to get hurt. In this case, I'm paying 7% now. Now that bond's paying 13 minus 7, 6%. So our spread is starting to look a little bit less and less attractive. So if I look at my annual cash flow now, after tax, it's went down like by 40K. So our profit spread is actually starting to get hurt a little bit now. Once I see a break even, I'm probably going to take my profit and run out of the bond. But like, see, like that's a high coupon bond. It's for such a short duration. There's low risk on it, so that's one of the benefits. It's because when in this case, it's paying me about 13% in coupon. I don't know, about 11% in coupons or something like that. In coupons. And it's for such a short period of time. It's got very, very low duration risk. So in this case, there's almost like, I can still lose money, but the chance of it is very, very low. So that's why I ended up taking leverage out for it. And plus, this could be a learning experience for me. If I lose everything, this is a learning experience. And that's why I saved the game. I think I'm going to start learning from a bit more about Howard Marks and stuff, because he says like risk is very, very important to consider, and I try to consider as much risk as possible. Like, I understand with Fortis and all the companies I hold, there's certain risk with them. With most of my stock portfolio, it's mostly linked to interest rate risk. If interest rates go up, I make a bit of money off some of my stocks. If they go down, I lose money. Some of the individual stocks I own, they do better in lower interest rate environments. Some of them do better in higher interest rate environments. So how is our spread working? Is it working okay? 340,000 minus 335. We're still at after-tax cash flow of 147k. And we're slowly paying off that loan. And so if we look at Office Depot, which is our only bond that we own, where is it? Right here. I don't want to do this. $300 million in cash and cash equivalents. Where are they? Are they considered A? They're still considered A. And they can borrow $5 million, basically. So they can borrow a ton of money if they want to. So they can easily pay me back. It'll probably make them more sense for them to pay me back. So in this case, I think it's actually a good transaction. I'm probably going to do a bit more convertible bonds after this transaction. Okay, our profit spread is starting to get hurt now a lot because interest rates are starting to rise. 9.5 now, so our profit spread is almost near break even. We're making 350k. So our corporate bond interest, we're making about $298,000 in corporate bond interest minus our interest. We're still making profit off this spread. By spread, I mean like the interest rate I'm making off the bond minus the interest I'm paying to the margin guy. So it's still profitable, and it matures in about 1 year. So I'm going to keep it for 1 more year of coupons, and then I'm going to get all my money back, hopefully, by that company, and then I'll pay back my margin loan, and we might make a few $100,000 off this deal. And interest rates are much higher right now, or at least they're a little bit higher than they were. And the second I say that, interest rates start falling. Fun. Well, interest rates are falling. That's actually kind of good for our transaction. Yeah, we're kind of flat lately. We're not making bank off the Office Depot. Yep, I can bank off this bond. I think we're actually continuously buying more and more of the bond. Hypothetically, doesn't tell me how many shares of the bond I own. How many bonds do I own? 22,000 of these. Cancel. It's gonna mature soon. Sorry about this, I'm kind of eating. I've been streaming for a while. Second, when we get our payout back, I'm gonna go ahead and I'm gonna go and pay back my loan. If tax rates were a little bit lower for ordinary income, we'd probably make a lot more money in this transaction, but we're not making much off of it at the moment. I should be updating this. I haven't updated this as much, like this little notepad thing. It's a little bit misleading. Maybe when this investment matures. There we go. Interest rates are low again. Gosh dang it. Okay, it's coming to maturity. Soon, I guess, right? 2039, yeah. It really wasn't the best transaction of it, but I think we still made money off that transaction. Yep. And it's coming to maturity. It's trading a bit below 100. I'm going to probably buy more of it because there's a potential arbitrage opportunity, but it makes no sense. Paid off in full. 799,000, and we borrowed. I forgot how much we borrowed, but we borrowed a lot of money. I think we made money off that transaction. Let's see, a little bit maybe, because like we've been flat mostly. So that was a potentially decent investment for me. So. Yeah, our bond funds are not doing that well. I'm gonna go ahead and buy an extra 200k of this. I haven't made at least 200k off the transaction because I'm pretty sure we started off at about 500k. And then we took a margin. We bought about 2.2 million. How much money do we have in cash? We'll put 299 in there. Right, we probably have a bit of tax to pay, do we? A little bit. So we potentially probably made 180k off that transaction. Not too sure about all the numbers in that transaction, but it was a good idea. I'm gonna buy 290k of this blue chip bond ETF. But I think it might be a good idea to buy more of this. So a little bit in cash. Dividend yield is 5.4%. What about the company info? List portfolio. They have a ton of bonds that they could potentially take capital gains on. I don't know why the fund is doing so bad then, because they have a bunch of realized gains, unrealized gains. Look at this. Market value is currently higher than the face value is higher than that. Yeah, so some of these bonds have actually got hurt. But it's still be good for their income. So I'm going to buy 290,000 of this stock at 24.76. It still takes a while for us to grow our wealth. Around that. Well, let's take that rounded up by 1. It still takes a while for us to grow our wealth because we don't have any exposure to equities at the moment. Okay. I think it's about time I update the sheet, and then I'm probably going to stop going live, and then I was just going to go chill and have a good rest of my day. So as of right now, we have cash of 509,000 minus, I think, 17,000. Okay. That's good to consider, the taxes. That's why I include it. So we have a stock portfolio. Stocks are worth 1509. Cool. I think this is a cool new series too, because like I can show you how cool ETFs are. Because I'm not really doing much active management of bonds anymore. I'm mainly just giving capital to ETFs in order to invest in them. AAA. So as of right now, we have a ton of stocks. We have some more blue chip ETF. So we're gonna be making some decent cash flow. About 21K. Add current cash balance. So we're making about 21K a year now. It's kind of bad. But I think as long as that bond fund does well, we're gonna be alright. And I want to start buying more lawn bonds and such. But like this would be a good thing to save. Oh wait, we need the current year? It's currently 2039. So I'm gonna stop doing bond funds for now. Yeah, I want to start doing more just individual bonds probably from now on, because I think those are a little bit better because I'm not really putting all the competency on the management. That's sometimes why I don't like ETFs, is because a lot of the time you're putting the competency on management, on people who are managing the portfolio, and if you have a lot of confidence, you might be better than them. Sometimes I believe that, sometimes I believe I'm better, but a lot of the time it's just psychology. I think I'm better, I have a big ego, and I just need to learn how to control my own ego. So in this case, we're going to go back to where we left off next episode. So I'm going to go ahead and save it. We have $2 million, so we're definitely not growing as much of it as an equity portfolio. I might change that, start buying me more convertible bonds. I like how I said this episode was going to be more about junk bonds, but I really didn't buy much junk bonds, but I did get some exposure through this ETF. So quite a lot of our money is in junk bonds as of right now. We're starting to actually go into a bit more investment grade credit. And we have a bunch of cash right now, which I'm going to plan on buying more government bonds and also buying into more corporate bonds. So I think it's going to be a very, very interesting episode or two. If I maybe go live for an extra 3 hours next time, I think the series will be over. So this will maybe be a very, very short series because I'm doing it for a long period of time. So I think it'll be interesting. I'm just curious how much money I'll have at the end of the day. I'm probably not going to have much. I'll be surprised if I make at least 10 million. I was thinking, I can get to 10 million. It's no big deal. But it's 2039 as of right now. And we're not making much. So if I were to do my return, so we have about 2 million assets under management right now. Minus our $100,000 start. 1.9 million. Right? Yep. So I'm pretty sure you do old minus new divided by old. No. 19 times 100,000. Oh yeah. Yeah. So we've about 19 times our money with profit. Okay. So we made 1.9 million in profit, right? No, how many years was that? So like I think we started in 2020. So it's currently 2039 minus 2020. It's about 19 years. I'm looking at about $100,000 a year. I forgot how I did the percentage. I think it was 19000 divided by 100,000. I forgot how I calculated the percentage last year. I'm pretty sure we're making an average of 19% a year. Not too sure about how much percent we make a year, but we've been doing pretty well. Been pretty flat lately though. That's expected of a bond portfolio because we're taking less risk. Save. Yep. So I'm probably gonna do more convertible bonds next episode, and maybe also do more. Maybe do more lawn bonds and just do a mix of those, and then receive income, and then reinvest that income, and then do well. Hopefully interest rates will be higher next episode. Therefore, I get to play with that. Because if low interest rates stay forever, I'm gonna be really bummed out because we're not gonna make as much. Anyways, thank you guys very much for watching. Sorry for the episode being a little bit boring, but I tried to do as much Bond strategies as possible, try to grow my wealth, and I hope you guys learned a thing or two, because I found it very interesting. You guys could probably learn a lot off of my rants and everything, because a lot of my rants about like, oh hey, is it better to pay off debt, etc. I could probably turn those into little clips and make them on my YouTube channel. I'm starting to think a little bit more in my head about my YouTube channel and take it a little bit more seriously, because over the next few days I've been trying to enjoy my summer too. Like, that's what I'm just basically trying to say. For the past 15 days I've been enjoying my summer most of the time, but I think it's about time I get to work on my YouTube channel. Anyways, thank you guys very much for watching. I hope you guys have an amazing day. Bye.